Hit it.
Oh, let's
try that again. Here we go. Leave all this in, Lena. Hit it.
It's Friday, June 4th, 2021, episode 134. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back the godfather of option positioning, Cem Karsan. We have a terrific discussion about why regular folks should care about dealer inventories and why traders might think about pulling a Costanza when it comes to their summer positioning. Then we have the good fortune to have Edwin Dorsey from the Bear Cave join us to talk about his new letter focusing on short selling. After that, in Talking Charts, Patrick gives us his very own Magic Mike impersonation. And no, the ladies don't seem to like it as much as one Channing Tatum does it.
Okay, and because I'm on the road, we're doing a slightly different format, but we'll be back to our normal scheduling in the coming weeks. And also note that Cuppy's Corner will be featured next week when I'm down in Miami. But one thing that isn't changing, Kev, is we'll be drinking some beers along the way here. So stick around. We got a great show. Lena, hop on. What beer am I drinking this week?
So Patrick is drinking Stone Brewing Company's Buena Vesa Salt and Lime Lager.
Nice. So what we decided to do was, since I'm on the road, we'll go do some of the beers that are available out here in New York and down in Miami. And you're going to be down there next week with me in Miami, right, Lena? So we'll try out some of the...
Keeping my fingers crossed.
Yeah, we'll be trying out some of the different beers down there. And Kev, you're just going to be drinking your...
Labatt 50.
Yeah, exactly.
Beer.
All right, Lena, do you have something to describe?
It's a little bit longer than usual. So this is from the brewing company. Stone Buena Vesa Salt and Lime Lager was born here in Southern California, which is vibrantly influenced by our neighbors to the south. SoCal's warm weather lends itself to outdoor activities year-round, from surfing our coast to snowboarding and biking in the mountains, off-roading through desert lands, or boating and fishing in our lakes and rivers. This Baja-inspired lager is the perfect companion. Brewed with just the right amount of lime and sea salt, it's everything a lager should be: crisp, refreshing, and full of flavor.
Yeah.
It sounds like something I like, but the fact that they named every sport that you can do in California just doesn't... I don't know.
Gotta be athletic.
You know what? It has a very Corona kind of taste to it.
Okay.
It's a nice, easy drinking beer. I could totally drink this whole
Okay,
summer
bring me
long.
home some, Patrick.
All right, sounds like a plan.
Okay, so
right,
here we go with the
Yeah.
disclaimer. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the glorious gamma gust, the mad macro mumble rumbles, and the feckless fed fumbles.
Ooh.
I
just don't want the second one.
I picked all the ones with the alliteration today.
There you go.
I'm a man of
But
little
are we
mind.
running low on those? We need our listener
that's
help
right.
again.
If anyone has any, please pass them along.
There you go.
Because we can't come up with anything. Okay, let's
All right.
go on to our first interview.
We're excited to have Cem Karsan back onto the show. How you doing, Cem?
Good. Thanks for having me.
Cem, it's Kev here. And I was just laughing before we started because I've been taking notes. I have 3 pages, maybe even more, 4 pages of notes, and I have a plan for this interview. And, Lena and Patrick will attest that I do not do this very often.
Uh-oh.
So I thought I'd just kind of sketch out what we're going to do here and make kind of a plan. What I thought would be interesting is to, first of all, go over why option trading is something that even regular investors should care about. Increasingly, this is kind of important to the flows of how the market's doing, and it's actually a little bit of the tail wagging the dog. So I thought we could start with that. Then the second part, I wanted to go through and we could figure out to try to decipher your great Twitter content that I was laughing and telling you that I can't tell you the number of people that asked me to kind of decipher what it is that you're talking about and what this means. So I thought we could maybe take a couple of examples. And then finally at the end there, we'll go through your strategy of how you trade and how you take advantage of these. So you ready to jump into it?
Let's do it.
Okay, so let's start with understanding why regular traders and investors should care about the S&P 500 dealer positioning.
So dealer positioning writ large, S&P being kind of the flagship, most centrally important product in the vol space, but dealer positioning in the vol space is incredibly important because it's where the risk premium, basically where the tail in markets gets hedged. All risk premia in the market, all liquidity premia, all of it correlates to one essentially on the tail. If you think about it, everybody is long, whether they're long equities or not. You have a job, you have a home, you're alive, you're long, and ultimately the risk that you have to your career and feeding your family and taking care of all your dreams, the risk to that is on the tail. And so institutions hedge all of that risk in some form in convex products, insurance products essentially on the tail. There's a tremendous amount of notional leverage in these products. If you think about how big the economies are of the world and how much risk we're talking about and how much leverage is needed to hedge that, there's an immense amount of notional leverage on the tail. When people want to hedge that, somebody on the other end has to be willing to sell that insurance. An insurance business, and many insurance businesses, insurance companies are a great investment, right? Just ask Warren Buffett. And this is the biggest insurance product in the world. So people are very, they're companies, many companies and businesses that are set up to profit off of this insurance. It's essentially the biggest carry trade on the planet. And what do I mean by carry trade? Well, there's S&P 500 skew is the highest skew for options in the world. What does that mean? That means downside protection versus upside protection. Insurance is dramatically higher on the put wing.
Okay. Actually, can I interrupt there? Why don't we actually take a moment and explain to people, like, with actual, like, numbers?
Sure.
And like, maybe you could just bring up and tell them, okay, this put is priced here, and this call is priced here. So why don't you just walk us through a real life example of how that works?
Sure. I don't have my screens in front of me, but I'll give you a hypothetical.
Okay. Sure.
Let's say you're looking at 30-day vol. Let's talk about, and at the money here, let's say is 42 quarter, a 40 half put, let's say, out of the money.
Cem, you're already doing, you're using all trader lingo, and
40-50.
I know everyone's already
4,050. Sorry, 40 half.
I just
I know. I don't even notice I'm doing it.
Yeah. So he's Jim's talking about the S&P 500, and the at the money is 4,200, and he's saying that a put at 4,050, which is down 150 handles from the current at the money, is what price?
Yeah. Let's say that's priced on an implied volatility, right? Options are priced on implied volatilities. Let's say, and again, I'm making this up. People are going to call me out because I don't actually know what it exactly is right now. But imagine that's priced on a 30 implied volatility, right? The at the money it could very well be priced on a 12 volatility, which is probably close to what it is, and an upside call. Let's say 100 points out of the money. Let's say a 4,300 call could very well be priced on about a 10 or 9 even implied volatility.
Right.
And so there's a dramatically higher valuation and price to downside options, downside insurance, and that's because of this risk premium that I'm discussing. And so there is a actual, as it's tied to realized volatility, that's ultimately what you're trading it against. There is higher realized volatility to the downside historically than upside, right? So some of this is there's a fundamental basis for it, and that too is simply tied to the fact that the world is long, and so when the markets go down, there tends to be more panic, and markets tend to take the elevator down as opposed to the escalator, right? Which they take up. So, but that's not nearly enough historically relative to this increase in price. The rest of that is simply insurance premium. It is a volatility risk premium, just like you would expect for at the money, but dramatically higher even, right, than that risk premium because it's for downside convexity. That put may be a 10 delta put, right, which means you're essentially getting 10 to 1 leverage, right, on that kind of protection if it goes in the money. Right. And so, there's a tremendous demand for that drives those prices higher. And the people who are ultimately the insurance company, which are market makers, dealers, and that's what, when we talk about dealer flow, who are we talking about? banks that are warehousing this risk, market makers, hedge funds that specialize in arbing this out and taking the edge out of the market. And they are forced, if they want to, much like an insurance company, to take this insurance risk, they are forced to hedge out that risk, right?
Okay.
An insurance company would buy reinsurance, right, to make sure they are safe, not just because they're required to, but to protect their tails. They might buy other expirations of insurance from one another and other kinds of hedges across the marketplace to help offset their risk, right?
Okay.
As the insurance also decays, whether that's a function of time, right? Obviously, insurance contracts you write have a time to them, right? When that time passes, the insurance contract is no longer valid and it's expired. You've collected the premium if it's not in the money if you're an insurance company. But in the meantime, you have to hedge it. And so insurance, market makers, dealers, they hedge that with the underlying part of it. So if that option is a 10 delta and they are short it, they will be short 10 deltas of underlying S&P against it. If they're short that put, there also have to be long some skew and some volatility in some other places, right? Generally behind it, things that are less valuable, so maybe in front of it, right? But essentially, they'll have to position to against wherever the peak in demand is for insurance, with hedges to protect themselves.
Right.
And ultimately, as time passes, like I said, and implied volatility itself compresses, right? If after the March meltdown, insurance premiums were sky high. People had to cover. They were at distressed prices. Implied volatilities were really high. If you were selling insurance during that time and you were short stock, as it decayed, as the implied volatilities declined and people were like, okay, this is over, it's getting better. There are more sellers of vol, the prices came down. Those deltas of those options came down, the implied volatilities did, and the short stock that they had against it, they were forced to buy back. The positions they had against them, they were forced to sell. So these effects actually have a name in, we tie them to, Greeks, second order Greeks. Vana, you may have heard, some of my followers may have heard me talk about Vana and Charm. What are Vana and Charm? Vana is the decrease, the change in underlying delta of the insurance contracts of those options per percent move in implied volatility. Charm is the same thing, the change in the delta of those options per change in day, per change in time. Okay. Right. So as time passes, implied volatility drops. The hedges to those have to be unwound. There's also VOMA and Volga, which I'll try not to go too deep here. That those are also the changes of an implied volatility as time and volatility compress. And so these effects are incredibly influential to the directions of markets, and they're influential in a very structural way. There are certain consistent types of flows you can measure if you know what you're doing. You can measure where the positioning is and ultimately how that's going to unwind over time. It allowed us to take advantage of a lot of opportunities in the last year or so that I've talked about publicly. One, the election last year was a implied volatilities were very high. They were overpriced due to fear. And after the event was finished, regardless of the outcome, even often when it's the worst outcome, those implied volatilities still have to decline regardless of the outcome. And that ultimately drives buying support and buying back those deltas. It also creates vol compression. It creates kind of a loop where there's vol compression, which drives more, delta buyback, which drives, more support, and so these two things affect one another as well. Right. So ultimately, these are critical components of how markets work. I've talked about a couple other podcasts and on Twitter about how they really define a lot of the characteristics that most people, on a correlation basis, understand about how markets work. Never short or dull market. Why do markets tend to push higher, right? As the market, if the market sits in stasis, ultimately it's not because of greater earnings over time. It's really about the fact that there's ultimately constantly a buyback as these premiums decay. If you don't decline, there is a natural set of flows, significant flows that come into the market every day, and particularly during certain windows. It also describes a lot of the overperformance into the end of that day and overnight and into the mornings that people have been talking about. Almost all of the positive performance in markets is concentrated during that window. So it describes a lot of, again, I could go on and on about this, but it really describes a lot of important structural dynamics in the market and how markets actually work on a day-to-day basis.
Right, and this flow is becoming increasingly important as more and more people are using the insurance product that we're talking about.
Correct, and so as option volumes as relative to the amount of liquidity in the markets increases, obviously these effects increase. I think it's particularly true, and we live in a very liquidity-driven world. It's a function right now much more of any fundamental cash flows to businesses. It's much more about who's buying and who's selling at any given time. Not that hasn't always been the case in the short term, but that's really what's driving things. And so vol flows, which are increasing, are a greater driver than they've ever been.
So one of the things that I'd just like to stress is that these kind of scenarios or these situations where we get the Vanna bid, where we get the charm bid, it's a function of the type of products that the clients, the end users, are asking for from the hedgers. And let's just go back to it. Traditionally, what they do is they come and they buy a put. An institution, they buy a put, and then to fund it, they sell it out of the money call. And basically, the dealer that takes that risk, is worried about that put going in the money, and has to hedge that. So they're short against it. And then as time goes on, they have to buy it back. But one of the things that I just kind of wanted people to be aware of is that this is what occurs in the S&P 500, because traditionally people are demanding insurance to the downside. It would be a completely different situation and, in individual stocks, and we're seeing almost the opposite Vanna and charm effects in stocks like AMC and GameStop, are we not?
Yeah, so I think, if people have been following along, we were able to make a pretty early call on that this rotation between what we kind of deem value. It's not really value, but quality. S&P type stocks relative to the Nasdaq and tech complex. That rotation we saw early on, not just because of the shift to fiscal, which we've talked about. Fiscal dominance, but really on kind of boots on the ground, day-to-day level, it was really because dealers were massively short calls in that complex, long put, and in the S&P, even more than ever, they've been short put, long call. Right. So you really have a what we call a risk reversal swap or a collar swap going on. And it's driving consistent, steady flows as you approach expirations, as you approach decay of these products. To dealers where they're forced to buy S&P, sell Nasdaq, and that's only helps exacerbate, right, a lot of these other fundamental flows that you're seeing coming from kind of the top of the flows pipe from the Fed and the Treasury.
Okay, so one of the things that I've been wondering is you mentioned earlier the fact that the market should have a natural skew to it. And meaning that the upside call should trade at a volatility that's lower than the downside call. And the last time you were on our show, you explained that over time you realized that your expected return from warehousing that risk was never as large as you expected. Meaning that if you looked at this and you kind of decided that really the upside call should be 12 and the downside call should be, let's say, 20, and you ended up selling a 25 and buying a 10, you should expect to make that money. And over time, you found that that was not the case. Why don't you tell us about that experience and what kind of conclusion you came to from that?
Yeah, so necessity is the mother of invention, right? So how did I come up with all these kind of theories and these processes and these strategies? I was a market maker, one of the biggest, in the indices, during the financial crisis from, the great financial crisis, 2007 to 2010. And, I warehoused a lot of the street positioning. I had a lot of other people that I knew what side everybody was on because I was wearing it.
Yeah.
And ultimately, when you have that positioning, you have to hedge it, manage it, like I was talking about. And ultimately, everybody was trying to hedge and manage those, proactively against each other. And when people are kind of stuck in the same positioning, even if it's a great relative value trade, right? Like the maybe selling a really high vol, buying a low one, ultimately, pretty much every factor that could go wrong, right, to make that trade, even though it's had a great margin of safety, would go wrong, right? in a structured, very almost predictable, consistent way. And so the more and more we track these, yes, they'd still be profitable to some extent. You'd still kind of, but ultimately, I think any market maker out there will tell you that broadly, the positioning, they expect their positioning to lose money. And it's not just because customers are quote unquote right. Even if they're hedged proactively, their positioning, they're constantly battling a loss on that side and making their money on the edge that they're trading, right? At least historically. And, obviously they've had to turn into more proprietary trading companies than they were just market makers, right? And this is the thing that, drove us early on to realize this and proactively start taking positioning ahead of these rebalancings, right? And so we had more information than everybody else. We know how to track these because we were wearing those positions and seeing them in real time, and we were able to then get ahead of the flows and the trading that everybody else needed to do. Now, to be clear, that's not just the deltas we were talking about. That also, imagine you're long a calendar, out of the money calendar put spread, right?
Okay, so why don't you explain to people what that means?
Yeah, sure. So imagine you're short a 10-day out 4150 put, and you're long, which is, let's say, a 10 delta, and you're long a 20-day out 4100 put, and maybe that's a 10 delta too. Okay. I'm just kind of making stuff up, but just so we're on the same page. Yeah. And that's a delta neutral spread, right? In theory, as time goes by, the one in the front is going to they're both going to decay, but the one in the front is going to decay faster. It's going to decay to zero, and definitely by 10 days. And so you're going to get shorter and shorter delta, but you're also going to get longer and longer vol, right? Because the one in the front is decaying, and you're getting just long the one behind it.
Right.
You're getting longer and longer skew, right? Because you're long downside options. And so all of this exposure have second order Greeks that you can measure, right? So in that situation, you can expect, if that's the way the whole street is positioned, there's a major trade that has everybody forced that, skew broadly is going to decline. Implied volatility is going to decline into that as that decays on a daily basis. And you're going to, and delta, charm hedging and is going to increase. Those all have a feedback loop as well. Like I was saying, that's the great irony of this. When you have that type of positioning, right, you can get into these kind of death spirals where implied volatility comes down, right, because of the positioning, which drives a decrease in the delta of those options, right? Which then leads to more support, which then leads to more vol decline, et cetera, right? So, and so that type of positioning is something that you have to be aware of. Obviously, it's not as easy as just getting ahead of those flows, right? Because those flows will ultimately be a function of whether or not those options go out of the money or not, right?
Okay.
And so, understanding these dynamics and where the dealer positioning is very important for understanding the distribution of outcomes. It doesn't necessarily mean exactly to buy stock today, but if X happens, then Y is going to happen, right? So you can really start to predict, if maybe that positioning will cause a much fatter tail in the distribution, because if you went down, then everybody would be short the 4150s. Everybody would need to cover the gamma in there. There'd be lots of risk, right? If people were front running, now they'd be forced to go cover, et cetera. So it really does create a good model for understanding where the actual supply and demand exists in the market and at what points in the market they matter and in which ways.
Okay, so I think that you hit on something that's really important there, that the kind of bigger picture traders and investors can take home from this. It's that the dealer positioning affects the distribution of returns while that positioning is occurring. So meaning, therefore, if all the dealers are long gamma at this point, then chances are, or relatively, we will have a closer distribution of returns. Why don't you explain to the people why that might be?
Yeah, so let's speak to what's going on right now in markets. I think this is a good opportunity to do that, and a historical reference to to when this also happened more dramatically. In 2017, we had the lowest implied volatility in history, right? That drove, and most people don't realize this, that drove the lowest realized volatility in history. Now, when I say in history, realized volatility, we have history for it going back hundreds of years, right? This was 30% lower than the next lowest realized volatility in history in the year of 2017. Yes.
Over what period? When was that? I just want to dial it.
The whole year of 2017. If you take it as a year,
it was the
lowest realized volatility of broad markets ever by 30%.
Holy smokes.
Did that contribute to the Volmageddon?
Yes, it is. It did, absolutely, and we'll talk about that. And the two are very tied, right? Okay. But yeah, 100%. I'll address that at the end here. But so 2000, and everybody was, most people who start with stock, right, and just assume indexes are a calculation of the underlying stocks, right? The explanation, kind of by most talking heads out there, was like, "Wow, this was driven by really low." Implied, like really low correlation, because we also had the lowest correlation in history by about 20%, right?
Okay.
And again, in history, hundreds of years, and nobody that wasn't in the market making kind of vol world really understood that the opposite is actually what was happening, because implied volatility was compressed. Right? There were massive sellers. Why? Because massive Fed stimulus, more than we've ever seen, a ton of support to markets that ultimately drove lots of yield generation, sellers of implied volatility, right? There were tons of strategies launched that sold iron condors and all kinds of other vol, right?
Okay.
Not to mention the amount of liquidity support there is, right? If you have a massive Fed stimulus, people are buying the dips, people are supporting the market. So that ultimately created this loop, which dealers who are net stuck long that vol have to, and gamma, they have to hedge. When the market goes down, in order to monetize that, they have to go buy the market. When it goes up, they have to sell the market, right?
So they're muting the volatility through their hedging actions.
That's exactly right. Not to mention these Von and Charm flows, which are naturally supporting a slowly grinding up market on top of that, right? So the two together not only compress the market, but the Von and Charm, the skew in the market, causes a steady, climb. We didn't have a decline greater than 3% the whole year.
And
right?
so you argue that this was the direct function of clients selling options to the market makers.
Absolutely, and I'm confident of it, not just because I saw it real hand in front of me and I was a part of that hedging, right? But also because I think the correlation being the lowest it ever was in history makes a ton of sense as it ties into it when this is the case. Why? Because of the S&P itself is what's pinned. And that's, to be clear, when I talk about correlation and implied volatility being the lowest ever and realized volatility, that was centered around the S&P, right?
Okay.
That wasn't necessarily as true for other indexes and other components, right? Because those weren't vol centers, right? So if you have somebody who comes out, a company comes out with for the cure for a disease or a new technology or something that their stock is going to move, right? That they're still going to move. But if that index is pinned, that means other stocks ultimately have to go in the opposite direction in order to keep that index pinned. And that's what actually drove the lowest correlation in history, right? And I think that's what's so important, that these mechanics are structural, and the S&P 500 and these indexes, they're not just indexes that are measures of the underlying. They are actually centers, dramatic, often, and I think right now more than ever, they are more the tail wagging the dog, right?
Okay.
And so I think it's critical to understand that. We're in a similar thing right now. And actually, if you look at historically, if you look at returns and implied volatility, selling or buying, selling volatility is best actually historically when it's really low on a risk-adjusted basis, believe it or not, when it's really low or it's really high. When it's in the middle period, it actually doesn't perform nearly as well. There's not as much of a volatility risk premium when it's in this 18 to 24 area historically. And that's exactly because of what we're talking about. When implied volatility gets pinned, it reflexively creates more pinning and makes risk-adjusted selling it actually a pretty good strategy,
So
as well as
so
obviously when it's higher, which people understand.
so the S&P, so the VIX might be a better sell at 17 than it is at 22.
I'd argue it's a better sell at 13 than it is at 22.
So, Jem, why don't you tell us how that resolved itself with what Patrick was asking about with the Volmageddon?
Yeah, so ultimately, the way these things resolve themselves is finally all the selling gets to a point, right, where the positioning is so, and people were profiting so much on selling it, right? They piled in, and in particular into several products like the XIV, right, which were structurally at risk. And the street realized how bad this positioning was, caught on, and people started to actually, much like they have with ARK recently, and a lot of other entities out there, when things go wrong, people smell blood, right?
Yeah.
They're able to kind of go after it and force the thing to happen. And ultimately, XIV, the writing came, went on the wall that it had gone too far, and the street started betting against it. And ultimately, they squeezed redemption in that product, and that drove an unwinding, which was a very important thing, an unwinding of that vol pinning, which then not only created a massive decline in the market and freed up the market to actually move dramatically, but it actually blew out a ton of vol sellers, right, who had been profiting during that period, in the S&P and other places, and really laid the groundwork for what we've now seen, a more elevated vol, a more a market that is more at risk, right? At least until recently. Historically, before we get any major financial downturn, there's almost always, especially in the last 20 years, a kind of warning shot.
Okay.
It's something where you get a XIV type moment, right? Where implied volatilities are forced out of that declined level, right, to a kind of higher plateau, and then eventually the market can move and then react to other news and ultimately lead to a more secular decline. So anyway, so that's kind of how things played out. Obviously, it's not like, hey, implied vols are low. It's a sure thing. Go sell vol. Right?
No. In fact,
but the probabilities, and the way the system is structured, create kind of these loops where the more it's compressed, the more likely it is to continue to be compressed. And particularly during certain periods where you are, and referring to now, what's happening now, we're in a period where there's a couple big street trades that are, JP Morgan has this really big put spread versus call in the S&P that they do. It's a put spread collar.
Is that the 4115s?
Yep, those are the 4115s, and those are the calls in that structure,
right,
in June, and they roll it at the last day of each quarter.
Yeah.
And when that leading up to that, any market maker worth their salt or any dealer knows it's coming, and they prepare for it, right? They make sure they're not long vol into that period. They sell vol. And any flow that's predictable like that has people getting out in front of it. And so leading up to that, you have significant vol compression in the week to it, in front of it. On top of that, we have these Von and charm flows going into expiration currently. That's what you're kind of seeing right now. And we're at a very well-supplied situation in vol markets. It's been the case for now about a month, where our dealers are stuck very long vol and very long gamma, and that's been pinning the market.
Right.
The pinning that we're seeing in the market is not a surprise to people who see what's happening here, and they understand why these things are happening. So we have until about July 12th. I've been tweeting about this for the last 9 trading days, and it continues to be clear and true. And I think this is just the beginning. We continue to have extremely oversupplied vol in a situation where more and more implied vol is coming onto market, right? And so going to be very hard to shake that given the supply that's coming and given where the positioning already is. And and as you've seen, like today, you're going to continue to see compression on that implied volatility. This could very well last all summer. My guess is that we're going to have a very, very slow summer. It's already started. We've already expected this up until now, and I would expect this carries on until at least July 12th, and my guess is really through August.
Can we talk now a little bit about what happens on the other side when we get something that breaks markets out of the ranges that where all the dealers are long gamma, and it actually goes down to where they're short gamma, and what happens there and how that works? And maybe you could use the COVID example to walk us through how
Yes, that's a great point. So what happened during COVID is, very few people fully appreciate that story is not just about COVID, right? COVID was the spark, but not a coincidence that the market bottomed, on the day of March quarterly expiration, right?
Okay.
It also not a coincidence that it started the day after February, right? It was literally followed an exact monthly OPEX cycle,
right,
from the beginning to end. And, that's because of all this positioning. Why is that? So all of this positioning on the tail, dealers are trying to do what we're talking about, right? They're trying to stay ahead of these and hedge their positions, and they don't want to be the last one buying the stock, for Vana and Charm, right? They don't want to be the last one selling, but they also need to be careful not to be too quick, because if things decline, they can get caught on the wrong foot, right? And what happened is we had a 8 sigma, the biggest monthly decline in history. And when that happened, obviously most models weren't suited for it. Dealers were stuck short a lot of that area, and there just simply is not enough liquidity on the tails. We live in a world right now where liquidity is rampant. And what does that cause? That causes compression of volatility at the money, right? Because like we talked about with the 2017 example, people are selling volatility for yield. They're also going out and buying the dip, right? Because there's a lot of money sloshing around. They want to buy assets on a decreased valuation, right? But when the market does decline, the amount of derivatives tail exposure that exists in the market, given how much leverage there is on assets and how much, embedded leverage there are in companies, as well as on just balance sheets across the board, and derivatives exposure, you're going to need, you're going to have dramatically higher selling in those situations than you would have, and not enough liquidity to ultimately meet that demand.
Okay.
So you have the situation where, our models are all fat-tailed at this point, and they have been for a good 5 to 10 years, honestly, at this point.
What does that mean when you say fat tails at this point?
Yeah. So ultimately, the implied volatility at the money is actually narrower than most people think. But on the tail, meaning if you move to a 2 standard deviation type move to the downside plus, right? In those scenarios, there's just simply not enough liquidity to meet the amount of convexity in the marketplace. And ultimately, if you go to a down 15%, you're likely to go to down 25% at this point. Okay. They're just, there's just not enough liquidity to meet. And so implied volatility and skewness actually on the far tail is actually undervalued, ultimately, in our opinion. Relative to at the money is actually, overvalued.
Meaning that if we're going to get down there, the distribution of returns will actually be larger than the market is pricing in.
Correct.
Okay. And when you say, just so people understand, when you talk about liquidity, you also don't just talk about liquidity in terms of people buying stuff. You also talk about liquidity of them providing gamma or vega to the market that's demanding it because people want to hedge or want insurance even more at that period.
Correct.
Right.
Across all those. That's ultimately, people, the demand for hedging dramatically increases in that scenario, and the dealers are actually caught in a situation where they don't have the liquidity to provide it.
And then all of the things that you talked about previously about the Charm and the Vana, do those now all work in reverse?
If you go through the positioning, yes.
Right.
Which is exactly what happened in March. Exactly.
Meaning if the dealers flip from being long gamma, which is traditionally up here, they're long gamma, to short gamma, then all of the things that we talk about, those negative, every day when you get up and there's a relentless bid to the market, now there's a relentless offer to the market.
Well, true. There's kind of two effects. Okay. One, if the puts the dealers are short are still puts, if they're still out of the money, yep. Right, then as vol rises, right, the Vana is actually forcing them to sell
more. Right? That's correct. Yeah.
The secondary effect, though, which you need to keep in mind, if you move enough, those puts that the street was short, right, have now become calls. And so ultimately, if dealers are then short call, right, and long stock, as these things then decay, they actually have stock to sell. But if they rise, they actually have stock.
Now, why don't you explain to people
so,
when you say they become calls? And it's because they've gone through the strike. Is that correct?
Yeah. So
okay.
Due to risk, put call parity in markets.
Right.
And again, without kind of teaching an options class, I'll just have people go look that up.
Yeah.
But due to put call parity, an in the money put when hedged, right,
yep.
is equal to a call.
Right.
And vice versa. An in the money call is equal to a put when hedged.
So now I have some questions for you about, we'll just take a little bit of a detour off of the beaten path of the S&P. And I know that's your focus and things like that. But you worked in a lot of different groups and you've had a long career on Wall Street. And I was curious about like AMC. Like you're seeing these crazy volumes going through. And to me, it seems like there's just a wall of buying of Vega, meaning of options, just people buying. The reality is that somebody has to be selling it. I was wondering, are they just scaling into it and just kind of, they see this wall of buying, so they sell 500s and then, they're still buying. So they move out to 5.25, they sell those and they just do more and more and more. And then, at the end of the day, they delta hedge, keep, hope it's okay. And, they suck it up and get through it. Is that how?
Kev, what would you do if you knew that you had a relentless, unlimiting bid to?
I put it as high as I could to make a sale.
There you go. So you move it to a price that makes sense, first of all. Second of all, you probably start buying them ahead of them coming, right?
Okay.
I mean, if you know everybody's going to buy these calls every day when you come in,
right? Probably
makes sense to be long them before you sell them to them, right?
Okay, but somebody has to be short them though, right? Like for,
Well, absolutely. Yeah. And it's a chase, right? Yeah. The reality, this is why it keeps going higher in the market. But there's a lot of everybody. All the talk out there about meme stocks now for the longest time has been like, oh, this isn't Wall Street's bets. These aren't like, Joe Sixpack buying these. These are hedge funds, right?
Okay.
And they can go point to them. They say, look, Citadel is buying these calls, right? Well, why is Citadel buying? Because they know there's all of these people buying them every day, right? They're not just going to sit there and sell them.
Yeah, but they're going to be short. They're going to be on the whole short gamma, are they not? Like they're not.
Yeah, I mean, to be clear. They're not in the business of taking on positions,
right?
Despite what you may think, they're in the position of trying to get neutrality and take edge out of the marketplace.
But somebody has to be short these things.
Sure.
So who is?
Well, some fundamental hedge funds primarily, right? Like Melvin Capital, as we know about from earlier in the year.
But Melvin won't be shorting vol though. Will they? Somebody short the vol.
It's all ultimately tied in some form or another, right? They may not explicitly be short the calls, but again, to be clear, somebody shorted out there, and it's most likely somebody with an opinion, right? That's not tied to these flows. And I think there's a big point I've been trying to make for a year now is, if you're taking positioning of any kind and unaware of flows, right? You're doing it based on, let's say, fundamentals or whatever other reason you want to put on it, right? And you don't understand what the flows are doing, you are taking a significant, risky bet, right? You're putting yourself in harm's way because ultimately in a liquidity-driven market, fundamentals are not what's driving price.
Right.
It's all about supply and demand. And so to answer your question, in my opinion, the people that are shorted are people who have an opinion about whether or not this is rational or not, or whether this is fundamentally a reason,
And so they're providing the Vega for the market makers that then kind of move it around and have different parts and different spreads. But the reality is that's who's supplying the Vega.
Correct.
Okay. And, actually going back to this, and you just kind of mentioned this, the flows, how important they've become. I heard you say something about like the fact that the daily voting machine has changed. And, and you talk about that versus the long-term Wayne machine. Why don't you just tell us what you mean by that and how it's changed and whether you think this is something that will revert back eventually, and what might cause it to revert back eventually?
Yeah. So to be clear, these changes are not the last 1, 2, 3, 4 years. Obviously, they've been increasing, but I think from a macro perspective, we've been in a 40-year, it's been increasing over the last 40 years, supply side economics kind of structural time period. And what does that mean? And when I say supply side, I on top of that, I mean, monetary policy, I lump in with that. Essentially, all of government policy has been driven to companies and wealthy individuals. That's been done through lower tax rates, originally with Reaganomics, right? And then ultimately through the Federal Reserve, which really accelerated that starting in 2001, and then again, obviously, in 2008. But lowering interest rates, right, and providing quantitative easing is ultimately something that helps corporations and wealthy individuals, because the lower middle class, the average, the median person doesn't borrow a lot of money. They can't borrow a lot of money. Corporations are the ones borrowing money and ultimately taking advantage of the QE flows. So what does that do ultimately, and why is this all important, right? Ultimately, that money that is going to corporations and wealthy individuals is leading to more and more investment, right? It's leading to more investment in companies, whether the corporations are buying other companies, whether wealthy individuals are investing their money in those corporations. And that means those corporations and those individuals are awash in liquidity, and they no longer need, there's infinite liquidity for companies. There's no longer need to make profits in order to justify valuations. And so we got to that point quite a while ago, honestly, where we can fund companies if it's a good idea, like Amazon or Uber or or Tesla, that don't make money for many, many decades, right?
Yep.
People buy into the idea, and ultimately it's self-fulfilling, right? Most of these corporations never would have made it, wouldn't have even been close, right? They would have died on the vine years into it. But because we've created a scenario where money is essentially, for corporations and wealthy individuals, is limitless in terms of its availability, we've created an industrial revolution. We've created a real growth in corporations, but it's also created duration trade. Companies that are just big growth ideas are ultimately, as long as it's an idea that you think will eventually win, given unlimited capital, that's what you want to buy at any price, right? Because they will eventually dominate the market and monetize that at some point. And this is a long-winded way of saying liquidity is all that matters in that world, right? If the cash flows to a corporation ultimately don't matter in that scenario. They're almost irrelevant in the long term, right? And so, we're going back to a world if interest rates now start to increase, right? We've moved now for the first time, because the only problem with this is it's caused inequality, right? The whole idea of a rising tide lifts all ships works to some extent, but if you look for over 40 years, the average, the median person's income has increased in real terms, about 1% a year for 40 years, whereas the top 1 and 0.1%. And I'm not being political about this. This is just reality.
Right. You're
right?
just calling it, saying it as it is, and
saying it as it is.
Right.
And again, there are arguments for supply side economics. They maximize for GDP. They maximize for mean income growth. Okay.
Yep.
But they don't maximize for median income growth. And what's happened here is broadly people are upset. This is something that's been happening for thousands of years, right? The inequality has gotten to a point where the zeitgeist has changed and people have said it's enough across developed economies and otherwise. And it's brought up the Trump, now the right is no longer right. The right is left as well, right? Populism is what's being demanded by the people. And that's forcing more and more fiscal response, which is demand side economics. So ultimately, if you have demand side economics, right, that means the median person is going to start getting the money, which is what we're seeing with $6 trillion now, with probably another 1 to 2 on the way with the infrastructure plan coming down the pipe. People are buying goods, and that's leading to inflation. Because if you give average people money, they don't go invest the money. They go buy goods,
right,
and they provoke demand, which means higher interest rates, which ultimately means cash flows matter again, because the money is not free anymore, right? And so as we move down this path, which is a likely outcome, given the response here, that we're going to have more and more fiscal responses, a popular thing at this point. People, it's hard to imagine that in 2010, fiscal conservatism was a thing, right?
Yeah.
We're so far from that. We're heading towards MMT land and quickly. And so, ultimately here in that type of a world, you're going to be, higher interest rates, cash flows matter, more of this kind of rotation to value type names, but also volatility markets will also likely, as interest rates go higher, will also revert to a different type of structure. So less local implied volatility compression, right? Less less of a liquidity bubble, and all of the liquidity bubble that we're seeing is ultimately going to, will resolve itself if this continues to move along the path that it's going.
So that's some fascinating stuff. I loved your maximizing mean GDP and instead of median. I've never thought about it that way. I think that's a very articulate way to explain it. One of the questions I have for you is obviously, this means that the Nikolas and the Teslas are not as easily funded, and those. Maybe those stocks are shorts, and maybe, stocks that, like a Dennis Garman used to say that used to drop on your foot, maybe those are buys. But in terms of bringing this back to your volatility call, is there any way to take advantage of this secular change in volatility by buying long dated, volatility in any way? Or is there any way for people to think about, researching different ways that they might want to express that view?
Yeah, I mean, one of the places that we really like is we think interest rate vol has been so pinned for so long, right? And because you've had the Fed sitting on the other side of it, right? But there are opportunities there when you look at the longer end of the curve that we think are really appealing, that are dramatically underpriced. We think the Fed ultimately long term is not going to have complete control over the long end of the curve. I know that's a scary thing to say, right? Saying that the Fed, is not going to be able to do whatever they want. But if you think about, again, back to what I was saying before, the reason the Fed could provide unlimited liquidity and set interest rates to lower and lower levels, because if you give corporations unlimited capital, they actually, ironically, that's deflationary. Because corporations spend that money to reduce their cost of goods, to reduce the price, and to compete down to lower prices with other corporations, right? And especially if they have unlimited capital, their goal is to get more and more eyeballs, right? Amazon was massively deflationary, right? If you think about how deflationary, they didn't, they were giving things away for a loss. They weren't making money on purpose because they wanted to capture market share. Something like Uber is massively deflationary. They got rid of all cab drivers, right? Reduced their drivers' pay down to a significant fraction of what those drivers were collecting before, and made it more efficient via technology as well. So if we're ultimately pushing a technological revolution that's deflationary, ultimately that means you can print more and more money in response to a deflationary environment, right? But the second you get into a more inflationary environment, the Fed has a dual mandate. We haven't talked about inflation for 40 years, not realistically, right? But if you get real inflation, 3-4%, which the Fed seems to be okay with at this point, right? They are ultimately going to be put into more of a box, and they're going to have to reduce liquidity. They can't continue to add to it on a decline. And that's where stagflation comes into play and whatnot, and it kind of changes the game and the reaction function.
So, Cem, does that mean you're becoming more and more of a fixed income volatility trader?
No. There's, I still very much believe positioning matters, right? And that, that's some of the positioning, on that end. But the reality is, how is the world hedging this liquidity bubble? If you step back and think about it, there's so much talk about hedging and volatility, right? And because there are very few other places to hedge. Bonds are not a diversifier. Gold is not a diversifier. None of these things at this point, given the liquidity bubble, are diversifiers. So more and more people are out there hedging, right? They're replacing their bond exposure with some type of vol exposure. The problem with that is and we saw an example of this in early 2016 after the yuan devaluation in 2015 in August. In Feb 2016, the market actually declined more than it did in August 15, right? But the vol response was compression in vol because everybody was hedged. After August, everybody said, "Whoa, with interest rates, high yields, HYG and whatnot being priced at these prices, and oil imploding, trading $20 a barrel. Where's the best place to buy protection vol?" And so the world was hedged in vol. And when high yield blew out even more, and we started getting that decline in early 2016, everybody who was long vol as a hedge had to sell at the same time. This goes right back to that dealer positioning. And vol actually got compressed into a much bigger move than it had in August under the yuan devaluation. And so, my read on what's happening now is everybody's hedged in the vol space, right? So the next decline, again, I'm not a given, right? At least in the S&P where people are hedging, not likely to perform on the long vol side, right? Nearly what people expect. People are sitting on the back of psychologically of March 2020 and much like August 15, and going into Feb 16, and that supply ultimately will be, that will be available, into a decline and create probably vol compression into a decline, in my opinion. So how do I position? Those are types of things you can take advantage of. So you can sell S&P vol,
okay.
right?
So Jim, I'm going to jump in here because I think this is a great time for us to go through your tweets and try to put the Cem Karsan awesome Twitter game into English. Because so we'll just go through it here. We'll get to the second section. And what I'm going to do is I'm going to read you some of your tweets. And I'm going to have to use the pictures, and you'll have to explain them to us because I think you do a great job of getting more than the 280 characters that were allowed because you use pictures. But it ends up being a little more difficult. So let's just start with this latest kind of a thread that you have, and it's the first one says something a little different this time. A calendar for the Summer of George. So first of all, why don't you tell us what the Summer of George means?
So similar to what I was talking about here earlier is, there's a Seinfeld episode, right, about the Summer of George, and ultimately, George decides he's there's a Seinfeld episode about doing the opposite.
Oh, the
right?
Costanza.
The Costanza, right?
With the blonde at the bar, and he says, "I'm a fat balding man that lives with my mom."
Exactly, it works, right? And that's the whole idea here, right? You really want to know where dealers are positioned and do the opposite, right?
Okay.
And so my point here is, I had a tweet about that earlier, so you kind of have to follow along with other tweets and kind of catch where things are going. But ultimately, the Summer of George means, this is a time where liquidity is low, right? And positioning is significant. And the right trade is to position yourself counter that dealer positioning. And so when I say it's the Summer of George, I'm talking about that. We are in a time of dramatic vol compression with more coming down the pipe, right? Like I talked about. And ultimately, do the opposite and continue to ride it and lean into it because
do a Costanza.
Do a Costanza,
okay.
Right? And not just in the S&P, right? Meme stocks, anywhere the liquidity, you want to be long vol. I've been preaching dispersion for some time, and it's obviously working very well. Sell the S&P vol, go buy it in places where dealers are ultimately short the vol there. Because ultimately, when news does come out in that area, those areas are going to move.
Okay.
And correlation is going to continue to break down.
So actually, that was my next one of the things you wrote here. It says short SPX vol, long names. Okay. Now, first of all, for when you say long names, you don't mean long the actual deltas. You mean long the volatility of individual names. Is that correct?
That's correct.
Okay.
That's correct.
So whenever the street is short, wherever the street is short, own it. It's illiquid and reflexivity being this on the side of the street positioning is a liability. It's that simple. That's what you wrote. Now,
yep.
I was curious about this. So I understand being short vol. You could do it in a variety of different ways, but most people would understand that. And in terms of being long vols, you can go out and get long volatility in individual names. How do you go about doing this in enough stocks, and how do you figure out your ratios? And obviously there's some secret sauce here, but just give us kind of some ideas of things that people that might be interested in trying this on their own should be thinking about.
Without diving too deep, and again, there is some secret sauce in here. I can't go telling everybody how I do everything.
No, understood. We don't expect that.
But look, from 30,000 feet, we have a model that we've developed over many years that allows us to relate volatilities from one product to the other. Some people do, normalize in terms of vega. Some people do it in terms of theta, right? We have our own process of doing that. I won't get into the details of how we do it, but, we normalize, volatility one versus the other, and we create a basket of implied volatility in names where we feel there is a significant opportunity given street positioning and given the pricing that currently exists in that implied volatility. And we create that basket. We own it. We are very opportunistic in how we create that basket, right? We try and maintain some level of risk neutrality. Are we doing it as straight dispersion, meaning we're covering all of our risks, right, and just doing names versus ats? No.
Okay.
We're being very careful about our exposure and our net kind of vega and vol and delta exposure across products, but we are taking some tactical bets there and creating a diversified basket that we ultimately feel will have a much better outcome.
So in some ways, you're using the same ideas that you're applying about dealer positioning on S&P that you don't want to own the stuff that everybody owns, and you're taking it on the opposite. You obviously wouldn't want to be shorting the stuff that everybody is short.
Correct.
Or in the opposite, you want to own individual names. You want to own almost the expensive stuff that everyone in the individual names. You want to own the volatility that might appear expensive, but the reality is that everybody is all the dealers are short that volatility, so it might not be as expensive as it looks.
That's exactly right.
Okay. Now, a lot of these next things, I see you have time. And there's like a calendar and there's different windows and things like that. So I'll just kind of read you this next part and you can explain to us what's going on here. So you have June 7 to 15 is pre-fed IVOL plus oversupplied. Then there's a plus, a princess and a monkey. Okay.
It's a sloth, damn it.
Okay, so it's a sloth. Okay, yeah, I see it now. Okay, equals Mudville Magnet. Okay, so why don't you tell us what that cryptic message means?
See, the funny thing is most of my followers actually understood that nonsense.
Okay.
Because we, I take time to kind of introduce different concepts. The problem was when somebody comes in that's new, right, who doesn't have the history. So let me catch you up. So, going into implied vol, going into an event like the Fed, right, there is an event vol that gets priced in. A higher implied volatility gets priced in for an event like the Fed, right? And so what ends up happening there is because people, that's the higher vol generally because people are buying it. People want to be hedged for that event. And ultimately, dealers often are able to sell that vol at a much higher vol and buy some vol in front of it, right, as a hedge for much cheaper. And ultimately, reflexively, what that ends up creating is a scenario that going into these events, you often have a scenario where the vol gets compressed for the days leading up to the events.
Okay.
Right? Does that make sense?
Yeah, because they're all long.
Okay.
Okay. Yep.
Because they're long the gamma, they're long the short-dated vol.
Right.
And then as you get to the event, there's a short window for something, some volatility to happen, right? And then in other words, the vol dynamics then change at that moment. And so the point here is when I say what I say here, I'm actually looking at the tweet is pre-fed implied vol plus oversupplied. It's already been oversupplied, and you have even more like leading into this, and you have even more supply because of this dynamic. So I'm basically saying, hey, until you hit the Fed, like gamma is cheap, vol is cheap, like this market's going to have a really hard time moving.
Okay.
June 7th to the 15th. And then plus, on top of that, because we're moving into that Fed meeting, as they happens to be on OPEX week, and actually is the exact day of expiration, right?
Okay.
VIX expiration.
Right.
And so the highest amount of Vana and Charm flows happen as those contracts begin to decay and expire, right? Particularly the Charm element, right, of time as you reach expiration accelerates. It's not linear, right?
Yep.
And so that sloth is Charm. Okay?
Oh, okay.
Yeah, I introduced him a while back, but sloth is Charm, and the queen is Vana.
Oh, okay.
So when I say plus Vana and Charm, so you're getting Vana and Charm flows that are very strong to that period, equals a magnet. I mean, we're not moving. We're stuck, right? We're pinned.
And might grind higher.
Yes, correct,
Okay.
correct.
And then go to the next sentence there. That's the Fed window, I guess.
Yeah, so that's the Fed,
Yep.
right? And it's expiration and it's OPEX, right?
Yep.
So now, normally that would be a time to be concerned and a little cautious, right? But because implied vol is also incredibly well supplied right now behind it because of that 41.15 strike I talked about earlier in the June quarterly that JP Morgan has provided.
Right.
If you think about it, like what is the exact hedge you want in case something happens during the Fed meeting, right?
That's that. You
want
own
something
that.
Yeah, you want to own something right under the market, right? That's meaty. That's maybe a week or two out,
Okay,
right?
yeah.
So this is the exact perfect thing to hedge for that, and everybody's long it, right?
Yeah.
And so people are positioned in a situation where the front, meaning the actual Fed meeting vol is actually high, and the vol is very well supplied behind it. It's a very favorable position. And going back to our market making days, what's going to happen if you have a very favorably priced trade, right? You're ultimately, the event passes and everybody's going to get longer and longer vol, right? Because the street is positioned that way. They're going to get shorter and shorter delta, going to our kind of calendar put spread analogy, right?
Yeah.
And ultimately, that's going to provide pressure more than it would be if that implied vol was lower for the Fed, right?
Yeah.
And it's ultimately going to create a vol crush when the Fed meeting's over. Going to create more Vana, more charm, and support likely strong equals rocket. Right?
Rocket. You're like a millennial.
I gotta play the millennial game here. That's like probably 90% of my followers.
Well, it's the only ones who can figure it out. Okay, so here's another one. I'm going to just go on to this thread to the end here. Maybe we could just tackle number 3 and number 4. So despite all this, market's still technically fundamentally weak and taper talk imminent, which means market is likely capped. Sell SPX calls under hedged, sell SPX puts fully hedged, tactically at levels, at windows, two-sided, buy eye vol where squeezes are, both up and down. Why don't you, try to decipher that?
Yeah, so look, we don't just look at, you can't just look at dealer flow,
Yep.
right? You got to look at flows across markets. These are an important component to understand. If you don't understand them, you're in trouble. But there's a lot of other big major things. And a Fed taper, going back to some of the things I was talking about a little while ago, is so important, right? It's critical. And honestly, if you think about this is actually kind of proof positive for how important these Vana and charm and these flows are, because we're talking about how they're battling these other, secular, like the Fed's introducing a very clear that they're about to stop massive support, for the markets, at least very slowly, right? They're going to taper. And the market knows this now. It's becoming clearer and clearer. But the vol supply and the Von and charm flows are being supportive. So my point here is, okay, there are all these flows, and normally these would drive the market considerably higher. But there's this other major thing sitting out there, right? The Fed is looking to taper, and they're essentially, the Fed, there's the Fed put where they sell puts. Well, the Fed's about to go sell a bunch of calls, right? They're gonna, if the market continues to grind higher, you better believe they're going to start tapering, and so that should provide some type of a cap to the market, right? So the play here is, implied vol compression. Yes, the market will likely grind a bit higher from here, but not in a way that you really have major risk on the upside, in my opinion.
Okay, I get it.
And so my point there is, hey, be tactical on a pullback. Find ways to sell calls. Sell puts, hedge to delta neutral, maybe sell calls and buy some stock. On a rally, you may want to sell calls under hedge, right? Because the vol gets pretty low up there, but you should feel fairly confident to write some calls tactically at levels where the opportunity presents itself.
Okay, so now we'll end with this last one here. Number 4, own convexity funded with local vol, as the tail is still ultimately fragile, but feel free to disperse, can't even speak, about the cabin. And then the gorilla has your back, and then there's three bananas. As far as the eye can see, the eye is actually an eye, but I figured that one out on my own. Lean in, but be wet because
water.
Be water. Summer of dispersion, summer of George.
Yeah.
So what are we saying there?
You put it that way, I feel really silly.
Well,
now you're
it's
making me
pretty
just.
good. It's like, I expected the only thing you're missing at the end is I'm vaxxed and waxed.
Yeah, no. So, I mean, people that will follow, again, all these things I've just kind of referenced earlier in the talk here, but conversation is, convexity funded with local vol means, look, the distribution is very narrow at this point. Vol locally is a sale, right? But that doesn't mean just go out there and sell vol, in my opinion. There are better risk-adjusted ways to do this. And the best risk-adjusted ways to do this, as I've alluded to, are one, to do dispersion, because this implied vol pinning is really central in the S&P, right? And you have opportunities to hedge it by being long vol in other entities. You can go to gross notional of 2x what you would do if you were just selling vol, but be really net, notionally much less exposed that way. And ultimately, you might win on both sides of the trade. So on a risk-adjusted basis, those are better. Dispersion is a much better proposition.
I get it. Yeah.
Scenario. And so I'm saying feel free to disperse about the cabin. And then two, again, the tails are dangerous. So, make sure you own a couple, go buy some tails, fund it, maybe go sell a little bit of extra at the money vol, then, maybe go sell 1.25x just so you can go fund some extra units on the tail. Because if this market ever does something crazy, right, you own those units, and ultimately those should pay for it, given that fat tail that we talked about earlier in the conversation.
Okay, that's awesome. I think I'm going to do better now when I'm reading your tweets. Okay, let's move on to our third and final thing, which is basically we've talked a little bit about why investors and traders should care about positioning. We've gone through your trades in terms of what you're tweeting out there. Why don't you tell me a little bit about your firm, what you're doing, what you're trying to accomplish, and maybe a little bit about the kind of your business and the strategies that you guys employ.
Yep. So we've run. We actually started in the business after I divested my market making operation. I had to put my money to work in the business, in investments, and I got I bought a bunch of long, real estate and private equity and venture capital, just like everybody else. But I, in the background of that, I ran what I kind of knew best, which is a structured vol trade, right? That was algorithmic, that served as a secular hedge to my portfolio. It was vol neutral. I won't get into the intimate details, but ultimately that was my approach starting in 2011. I had other investors who decided to join me at that point, and we ran that strategy for about 5 years. I won't get on the details here at this point, but that we ultimately ended up converting to a long vol strategy in 16, based on the requests of outside investors to build the business, and raise a bunch of money on the back of that. So we've run a long vol strategy since then with considerable success. Not an easy business to be in starting in 16, as I talked about, 16 and 17 in particular, with lowest implied volatility in history. Obviously, it paid off very well at the XIV blowout again in 2020. Obviously, paid handsomely. But broadly, that is not an easy business to be in. We've been excited about launching our vol neutral product, which we're finally doing, that we have a track record from 2011 to 15, and we're relaunching that on August 1st. So we're excited about that. Uses the same robust market maker framework that we've used as a trading shop here for many decades now, but paired with our unique kind of dealer flows, predictive distributions that I've talked so much about on here. So our approach is really to use those two things. So to discretely price what the likely outcomes are based on measuring flows, which we feel we do better than most anybody, and have a unique perspective on. And then again, have one of the best market maker frameworks out there, where we're able to price in real time inefficiencies on the surface, relative one product versus another, not just on a correlation basis, but on a dispersion. We look at that, those relative valuations on not just at a lot of market making shops will just look at the money vol, one product versus another. We really look at skew, kurtosis, term structure, twist, right? And these factors we look at across products, not just that tied to actual fundamental factors like size and growth versus value, in industry. So we have a robust model that helps tie all the factors of the surface to actual fundamental factors and allows us to see in real time what's high and what's low and where the demand and the curve is. And by tracking daily flows on top of that, we are able to really feed that into a distribution of reflexive kind of supply and demand flows, which we then use in our model to help select the portfolio. So a pretty quantitative approach, based on many years of experience, kind of from the belly of the beast. Excited to launch that vol neutral version of that, which will be much more of a yield product. And then the distributions have been so good since we rolled those out in 2018 that we're launching a product that's much different. Instead of a delta neutral vol arb type strategy like the other two, it really is focused on taking advantage of those distributions for market move and vol move. And we're excited to take a much more kind of classic market timing approach to trading these markets and taking on, given the success of those, taking a bit more directional risk both in market and vol going forward. So expanding the offering, taking our broad vol expertise and trying to monetize it for ourselves and for our investors in a lot of new and exciting ways.
So not only are you going ahead with all sorts of new offerings and new kind of products, but you're also changing the name of your firm.
Yeah. So Aegea Capital was the name of the firm prior. That was really, we're trying to since 2018 when we rolled out our dealer flow framework, we've seen significant, higher attribution of profits driven to that. We think that is going to be our primary driver of profits, even above and beyond the market making framework. It's what makes us unique, and we really wanted to focus on the flows as kind of what we're best at and who we are as a firm. Kai means ocean. It's also my son's name. It's my daughter's initials are IAK. So, it's also kind of this is new venture, new brand, really kind of, taking as we build the firm, really wanted to do that at this point when we're launching the new products.
Jim, I was kind of hoping that you were a big Karate Kid fan, and that this was your tribute to Johnny Lawrence, and that you were going to be drinking Coors Banquets, and that's what the firm was based on.
My son might listen to this in the future. I couldn't say that, even if it might be true.
Listen, you're a good sport. I have all my notes, and I have more questions, like the term, the term structure of skew. I didn't get there, and I know that that's a big function of what you deal with and things like that. And so all I can say is I hope you come back on the show and take us through that next round of kind of explanations, because I think there's so much more there for us to learn.
I always enjoy this. I'd love to be back. Okay. Thanks for having me.
So one last thing before you go, why don't you tell people where they can find you? Give them your handle on Twitter, and then maybe the link to your website.
Yep. So the Twitter handle is @jam_croissant. It's a play on my name, and our website is kaivolatility.com. You can reach us at either of those, and look forward to being back on here.
Terrific. Well, thank you very much. Thanks for taking the time. We really appreciate you coming on.
Thanks, guys.
Take care.
Thanks.
It's our pleasure to welcome to the show Edwin Dorsey, the author of the Bear Cave Report. Edwin, thanks for being with us today.
Kevin, thanks so much for having me on. I'm very excited to be here.
I was just Googling you and having a look, and I realized that, even though you are a young fellow, you're only 22 years old, I found an article of you in Institutional Investor. And it's titled, "Would You Pay a 22-Year-Old Stanford Grad to Expose Wrongdoing?" And I thought to myself, boy, this is, you've set the bar pretty high. You've already, been profiled in Institutional Investor. Where are you going to go from there?
Well, Kevin, thanks for that really nice introduction. So I took a little atypical path after graduating from college. I started an email newsletter as my sole source of income rather than working for a hedge fund. I'm probably going to spend at least another year growing the newsletter. One benefit of newsletter writing is you meet a ton of people and you learn a lot. Maybe I somehow use it to launch a hedge fund in a year or two, but when you're young, the future is really uncertain. So I'm not entirely sure, Kevin.
And I think the future is definitely bright for you. So let's just talk a little bit about how you got into this. You mentioned that you in this article, you mentioned that you actually interned under a couple of, or at least one of the most famous hedge fund short sellers around. Why don't you talk us through your path to becoming kind of a short selling newsletter writer?
Absolutely, Kevin. So I've been a big, very passionate about the stock market from a young age. Like in second grade, I was researching stocks. The transition to the short side for me happened freshman year of college. I was really lucky and I got introduced to Jim Carruthers, who runs a hedge fund called Sophos Capital Management, and Mark Cahodes, both early in my freshman year. And they're kind of the two best short sellers out there, two of the best. So I couldn't have better mentors. And that's what drew me to short selling originally, is meeting with them, talking with Mark, and just seeing their passion for it and seeing how like activist short work and just short selling research could, in some ways make the world a better place and have an impact. So I interned for Sophos on and off for my 4 years in college. And that's where I really learned the short world. I met a lot of the big players in the short world. They showed me how to do real research. They showed me like how to use Pacer to find lawsuits, how to use Edgar and find all the SEC filings. How to dig into companies. So that's kind of what got me started originally. And Mark was a big influence too in telling me to use Twitter and build up a Twitter following. And it turns out having a big Twitter following is essential for like an email newsletter to get people to sign up.
That's right. And you also must get people telling you, go look at this company. There's something fishy happening here.
Yeah, the way I got some credibility to start was this company called Care.com. They were a publicly traded babysitting platform, and my friend was a babysitter on it, and she's like, you should look into this. They're a little shady. So I started looking into it. I saw they had a bunch of lawsuits, and they claimed to be vetting their babysitters, but I was skeptical. So I tried to sign up on Care.com as Harvey Weinstein, and to my amazement, I passed their background check as Harvey Weinstein, and I documented it all, and I put out a report on it, and that went semi-viral. And to make a long story short, the company got upset. They called Stanford to try to get me in trouble. They sent a private investigator to my house. I went to journalists with a lot of this, and a year or two later, the Wall Street Journal wrote a front-page story about Care.com's safety issues, and the CEO, CFO, and general counsel all resigned. And I got some credit because I was really early on, like shouting about the issues about this company.
But that must have been somewhat frightening to, all of a sudden have a private investigator coming after you. I'm assuming they're serving you up with some cease and desist letters and things like that. And here you are, just a young college student, and all these crazy things happening. Did you ever have doubts?
Kevin, I think when companies push back, generally that's a good sign. And you got to realize there's probably a right way to push back. If you hired a lawyer or contacted me directly with errors in my report, I might have been nervous. But if you called my college to try to get me in trouble, what company does that? That's not a way you go about things the right way. So when you see frivolous or mean things like that, that's probably a sign to keep going.
Edwin, I can tell right away that you are definitely thick-skinned, and you have all the makings of a short seller. You relish a company coming after you. It gives you a sign that you're onto something.
Kevin, that's 100% right. Insults are a good thing.
Okay, so you come up with this Care.com, and this is now. Did you actually at this point, were you working at the hedge fund or in the summers, and was that a position that you guys took or
no? Care.com was completely separate from anything I did at Sophos. Care.com was a personal thing,
okay.
but Sophos was my internships during the summer, most summers, and they were outstanding. I think the world of Jim Carruthers. At one point, they were the second largest short biased hedge fund in the U.S. They're pretty private, but I think they do the best short work there.
Now, let's just talk about short selling in general, because I do find it kind of interesting that most of your, cohorts that are coming out of school, they're all busy YOLOing and diamond handing, 1 week, AMC calls. And here you are trying to, battle against this insurmountable wave that just keeps coming and coming and coming of buying. And, I actually kind of was surprised that there are any short sellers left.
So it's definitely a tough market for short selling. To be clear, I don't actually short the companies I write about. I make money only when people sign up for the paid tier of my newsletter, where I'll highlight companies that are good potential shorts in a way. But I'm not shorting it myself. I think the key for me is I've always really valued off the beaten path type research. No one wants to hear about why you should short AMC or Tesla or GameStop or a company everybody knows about. I really try to find the $5, $10 billion, $1 billion companies that aren't really talked about, that don't have a short write-up in the past, that don't have a lot of short interest, that are kind of off the beaten path and are boring. So like the Reddit crowd aren't going to spike it up. That's where I think the best research is. And there's a lot of like companies in this $1 to $10 billion space, US listed, that just don't get the scrutiny they deserve.
Do you think that that's a problem with a lot of people that are attracted to shorting? They look for valuation shorts as opposed to companies that are like I take it almost trying to find the layups, companies that are fraudulent, that there's obviously something going on that eventually when it's exposed, it's going to, be a zero or very close to a zero. Do you think that that's a problem with too many people when they're doing shorts, that they're misinterpreting what true short sellers do versus the people that are just going, this is overpriced, so I'm going to, take a flyer on shorting Tesla?
I would say the two issues I have with the way most people go about it is there's a lot of groupthink. People love all doing the same ideas. Like, why in the world would you want to spend any time on Tesla? It might be great. It might be terrible. But I guarantee you it's much easier to find a $1 or $2 billion SPAC deal that's a complete joke that's going to be at zero 2 years from now than it is to fully understand Tesla. So there's too much of this like groupthink, everybody trying to do the same names. And number two, I would say the bar for shorting is really, really high. Like over the last 100 years, the market's annualized positive returns of 9% roughly. Most companies do well over time. So the bar for shorting is really high. And just because something is slightly overvalued or there's a small problem, that it doesn't always necessarily mean it's a good short. It really needs to be comprehensive, and a company's got to have really big issues for it to be a good short.
Okay, so let's talk a little bit about how you go about finding those, companies with really big issues. I saw an interview recently, and you were talking about how you read every single SEC comment letter that is filed. And I didn't even realize that they did this. So why don't you tell us a little bit about what that is and why you read every one that's filed?
Okay, so I'm going to back up just slightly, Kevin. The biggest way I come up with stuff is Twitter. I'm on Twitter all the time. I follow a lot of people. I think there's a lot of great small accounts out there tweeting good stuff. The second big way is SEC comment letters. So the Edgar, the SEC's website, has a lot of cool tools that not everybody knows about. There's this area called the full text search tool where you can search basically any SEC filing over the last 20 years by word, by person, for certain phrases, and that's super helpful. And what I do is I go to the SEC full text search tool and I say I want to search all the comment letters. Comment letters are informal correspondence between the SEC and a company. They're not necessarily a formal investigation or anything, but it's the informal way the SEC will talk to company to raise issues about disclosures or accounting and stuff like that. Most of them are run-of-the-mill and not that serious. But every once in a while, maybe 1 out of 30, really highlights serious issues at a company. It's like, this disclosure is wrong. Why is this signature missing? These enrollment figures don't make sense. And you'll see this sometimes, especially for Chinese companies, where they'll be like, oh, there's a clerical error in our enrollment figures. There's a clerical error in our revenue figures. There's a clerical error. They love to say clerical errors. and then, you'll see that in correspondence with the SEC. You'll see a company's had like 3 different CFOs in the last 5 years. And then I'll be like, maybe there's like more problems here. And the reason comment letters are so cool is it's a way to find the off the beaten path ideas. If you're on Twitter talking to people, you're probably finding the same ideas everybody knows about. But if you're reading like the source documents, the SEC comment letters, you're going to find stuff other people have missed, and you're going to find companies that other people like haven't already looked deeply at.
Okay, so you have a couple of stories you're going to tell today of potential shorts or things that people might want to look at. Are either one of these actually an idea that you came up with from the SEC comment letter?
Medical Properties Trust popped on my radar partly because of the SEC comment letters.
Okay, so let's start with that one. What's the symbol?
MPW, they're a $12 billion REIT based in Alabama.
Okay.
what Medical Properties Trust does, Kevin, is they basically do sale leaseback transactions with private equity firms that buy for-profit hospitals. So a private equity firm will go buy a bunch of hospitals for $1 billion. On day one, they'll do a sale leaseback transaction with Medical Properties Trust to get $800 million of cash back and then sign a 40-year lease or something for the hospitals they just bought.
Okay.
What's interesting about Medical Properties Trust is they're fairly concentrated, where they're like 4 biggest operators, their 4 largest tenants are like about half of their revenue and half of their assets. And if you look deeply at some of these tenants, Medical Properties Trust trades like a first-tier assets with no problem. A lot of their tenants seem to be in distress or like close to being in distress. For example, their second largest tenant is called Prospect Medical Holdings. They were taken over by a private equity firm called Leonard and Green Partners, and they're getting a lot of letters from Congress being like, "You've mismanaged this hospital chain. You're trying to exit now with your equity worthless, but you've in effect just stripped this hospital chain of all their cash and are leaving it close to default." ProPublica did a story about this chain of hospitals, and they found that elevators were breaking down. They found that ambulances would often run out of gas while they were driving because the gas cards used to fuel the ambulances were never being approved after Leonard and Green Partners took over. There was
they're not paying their bills. They're not paying their gas bills.
They're not paying the gas.
You don't
bills.
want your ambulance running out of gas. I can say for sure that is not a good sign when you're picking your hospital.
And it's like, this is their second largest tenant. It's like, they were featured in a Frontline documentary recently. It's like, this seems problematic. And it seems like this hospital might be unable to pay their rent 2 years down the road, 3 years down the road. They don't seem to be in great shape. Also, these leases are usually triple net, meaning that the tenants are responsible for upkeep of the hospital and the CapEx and all that. But if you're skimping on that, then it's an even bigger issue if the operator decides to default or walk away, because then Medical Properties Trust is going to be left with the hospital, 1, at uneconomic rents, and 2, a hospital that's deteriorated with broken elevators and a lack of medical supplies. So there's these issues that are building that could come to light one day, but just because they're still paying their rent now, it hasn't really come out. The other example that I talk about, which is bigger, is their largest tenant is called Stewart Healthcare. It's about 27% of their revenue. And the SEC has sent Medical Properties Trust multiple comment letters about Stewart asking for additional disclosure. And every time the company seems to delay or push back, they haven't filed the financial statements for Stewart in the last 2 years. And when they did 3 years ago, it showed a $1.7 billion deficit between assets and liabilities. And Stewart has gone around recently and asked governments for bailouts to keep their hospital open. They've been sued for not paying their bills. And then the thing that's kind of most potentially problematic at Stewart is Medical Properties Trust keeps giving money to Stewart for different reasons. And what it looks like to me is Stewart might be having trouble paying its rent. And to avoid having a defaulted tenant, Medical Properties Trust is giving Stewart money. So they loaned their largest tenant $300 million in January. They invested $150 million for a 9.9% equity stake back in 2016. They set up a joint venture called Stewart International, where they put $200 million into this joint venture with Stewart, some of which went back to Stewart, the Stewart US, which could have been used to pay lease payments. There's all these weird circular flows of cash between Medical Properties Trust and its largest tenant that you wouldn't see at a normal REIT. That strike me as really odd. And then you look at what the analysts say, and they're like, oh, this is great. They're getting a closer relationship with their largest tenant. They're really asleep at the wheel here, in my opinion.
And wait, they're not quite a REIT though, right? Because am I mistaken in that they're lending money to PE, private equity, to buy the hospital? So therefore, they're really a debt fund, because I'm assuming they're lending at 80 LTV or something like that against the property.
No. They are a REIT. They're not. They're primarily a REIT. They also sometimes, to close deals, will put in a $200 million loan. But they're primarily a REIT, where they do these sale leaseback transactions. But unlike most REITs, they're also extending loans to some of their problematic tenants. which look like when a tenant might have trouble making rent payments, Medical Properties Trust doesn't want to say, hey, our tenant's in default or our tenant is deferring payments. So instead, they loan a tenant money to avoid having that default or missed lease payments. That's what it looks like to me.
So
but they are a REIT.
So now you've written this. Have they reached out? Have they sent you a nice letter or a mean one?
I published on them 2 days ago.
Oh, it's new. It's a new one.
So it's a new one. Somebody from them signed up for my newsletter, so they know about it. But I haven't got anything yet.
Hey,
I think
Edwin, at the very
time,
least, you know what? It helps with the circulation.
One of the benefits of my model, where I'm just like writing about 2 different ideas every month, is like, because you're not going into such huge depth and going after a company for like a year. Usually companies just, I think, will say, hey, this guy laid out his opinions as he sees them, but he's going to move on to something else. So the best we can is to ignore it. Like activist shorts who put their information out for everyone, I think they tend to get more pushback. But if you're behind a paywall and you're focusing on new things, every month, there's no real reason for a company to like get
right. They're more likely to go if an activist who subscribes to your letter likes the idea and then starts looking at it than that and then publishes stuff. That's where they would be more likely to go after you.
Yeah, and I also think if you keep it, relatively tame and don't exaggerate stuff and don't put things in big red letters and don't be too crazy, as long as you're understated and you're honest, intellectually honest and straightforward, I think companies tend to respect that for the most part.
Well, and it's often, I think you're absolutely bang on correct, by the way, when you say that the more they come after you, the more that you feel like you're onto something. I always remember the famous story of Warren Buffett saying, I welcome people to short my stock because that means they're going to have to buy it back later. and if we've seen anything over the last 6 months or 9 months with all these short positions getting squeezed, it might actually be a factor that's one of those factors that's actually positive for stocks. So maybe they shouldn't even be that upset about it. Okay, let's move on to your second idea. What's the next story that you have for us?
The second company is called Root Insurance. Roughly $2 billion company, went public about 6 months ago. And they're a new car insurance company that has an app that tracks you that they use to underwrite their insurance. So in order to get a car insurance through Root, you download their app. They'll track you 24/7 for 2 weeks. And in theory...
Come on, really?
Yes, so they're tracking your phone.
What's the symbol? Sorry, I should have asked the symbol right away.
The ticker is ROOT, Root.
Okay.
ROOT. And in theory, because they're tracking your phone, they can track how well you drive, because they'll use the phone's like location data to say, oh, this person's speeding, this person's braking aggressively, this person has a tight or loose turning radius, this person's driving at weird hours, this person's driving at normal hours, this person's driving in safe areas, this person's driving in dangerous areas. You can get a lot of data from like somebody's phone location, and it seems interesting. Like maybe it does allow them to underwrite insurance better and distinguish who's a good driver and who's not. In practice, what it looks like Root Insurance does is they'll extend low rates to people initially, and then every 6 months they'll hike the rates 20 to 30%. I know this because what I do when I'm researching a lot of these companies, Kevin, is I'll file FOIA requests with like state attorney generals for consumer complaints on companies. So I can see what consumers are talking about. And during the pandemic, not pre-pandemic and during the pandemic, all these people, Root clients, were getting 20, 30% price increases. And it's like, that's pretty messed up. Especially people would be like, I haven't driven at all for the last 6 months during the pandemic, and I'm getting a 30% price increase for car insurance when most other car insurance companies were actually lowering rates under pressure from regulators. That was kind of odd to me. And the second thing that's also infuriating is, based on the consumer complaints I read, Root Insurance, it seems like, makes it difficult to cancel their policy. So not only are they raising your rates 20, 30% every 6 months, they make it difficult to cancel. So like I would literally read complaints where people were like writing their state attorney general being like, I've tried to cancel and I can't, I've called them 10 times, I've emailed, but I just can't cancel. So can you please help me cancel my Root Insurance policy? So the combination of those two things, aggressively raising car insurance rates and making it difficult to cancel, is really problematic to me. The National Association of Insurance Commissioners actually has a great database where they like rate each company based on the number of complaints they have relative to the size of their outstanding policies, and they create an index where like 1 means you have an average number of complaints relative to your size, 0.5 would mean you have half as much, 2 would mean you have twice as many complaints as we'd expect you to have based on their size. Roots of 4, they're literally off the charts where they have 4 times as many official complaints as would be expected for a company of their size based on the National Association of Insurance Commissioners data. And it's like, like you kind of get a feel, maybe there is something to this telematics, but maybe they're also like, not being the most ethical car insurance company out there. And they're losing money despite a pandemic, despite doing all this, they're losing money. And then the last thing I think is most important is, even though telematics is cool and you might be able to get interesting data from a phone that's tracking you, 5 years from now, this is all going to be irrelevant, because the trend is going to be connected car data, where 5 years from now, you'll have a car that's literally tracking your location and uploading all the data from the car to the cloud. And that's what insurance companies are going to use to underwrite insurance. It's not going to be data from a phone that's tracking a car as a proxy. It's going to be data directly from a car itself. And that's going to be the trend, and that's going to make these phone-based companies like Metromile and Root obsolete.
And is this also one of your new picks?
So the one kind of long idea, and I'm personally invested in this company, is a SPAC called Autonomo. The ticker is SAII right now. Yeah. The SPAC should be closing sometime in June, hopefully. And they're like a connected car data company that like has a platform for this connected car data. So like insurance companies could buy data from individuals.
So this is almost the opposite of the Root.
Exactly. And I actually, so the one cool thing is I got to do an interview in my newsletter with the CEO of Autonomo, one of these connected car data companies. And I asked him point blank, what do you think of these app-based companies like Metromile and Root? And he said, like, I think they're in trouble. The future's against them. So that's where I am on Root. The one thing I will say, like to push maybe like in favor of Root, is I actually really like the CEO. He's a young guy. He seems really smart. He's a little scrappy, which I like. I'm not a fan of how Root's being run, but I think the CEO is like a sharp guy. And I think that might be why like some of these big hedge funds are invested in it. I don't know, but I've talked to a lot of people on it, and no one's really given me a good pushback on why Root's a good investment.
Okay, so Edwin, I'm going to put you a little on the spot. You mentioned 2 famous short sellers that you've learned a lot from. I'm wondering if you could come up with an example of something you learned from each of them. A lesson taken away. I know I didn't give you any warning, so I'm throwing you out there.
So,
or what you admire about their trading or their style on each.
Jim Carruthers, who was my mentor for a while, and I think an outstanding human being. One thing he told me is that the smallest amount of initiative can make a really big difference. So even though Jim's a huge guy, widely successful, I would see him cold email people and cold call people. And it's like that really, to me, cemented that no matter how big you are, you still want to take initiative and reach out to people and do things. So every day, Kevin, I try to DM somebody new, email somebody I find interesting, just asking if they maybe want to talk, maybe do a Zoom interview for my newsletter, stuff like that. So Jim taught me like the value of taking initiative and just reaching out, knocking on doors, trying to get in rooms, stuff like that. Mark, to me, the biggest takeaway from Mark is he showed me the value of Twitter. I did not have a Twitter account until I met Mark Cahotas, and he literally forced me to make one my freshman year of college. People sometimes say, oh, it's social media, it's a waste of time. Twitter is an outstanding way to meet people and to learn. And it's also essential for a newsletter. In fact, half the people that sign up for my newsletter sign up coming from my Twitter account.
Edwin, I would have never guessed that the old, I'm assuming he's older than me. I think he's over 50. And the old 50-year-old is telling the 22-year-old that he's got to start a Twitter account.
It's kind of funny, but that's exactly what happened, Kevin.
Okay, I'll one last question for you. Your favorite book on short selling?
Favorite book on short. I read more like investigative journalism. So
Okay, well, then give me your favorite investigative journalism book, or your favorite investment book.
Here. I liked Bad Blood by John Carreyrou. That was a great one. I'm a big fan of Gretchen Morgensen and Gregory Zuckerman. They're two of my favorite journalists. So read Bad Blood and read everything Gretchen Morgensen and Gregory Zuckerman writes.
That's great. Now, listen, before we go, why don't you tell people, A, where they can find you on Twitter, and then B, where they can sign up or check out your newsletter?
Kevin, at StockJabber on Twitter. If you Google Edwin Dorsey Twitter or StockJabber Twitter, it'll come up. And then my newsletter is called The Bear Cave newsletter. There's a free tier with about 15,000 people on it. And then there's a paid tier with where I focused more on individual companies. And I'd love it if people signed up and check out the Bear Cave newsletter.
That's great. So why don't you just repeat the Twitter one last time to spell it out for us?
At StockJabber, STOK. STOCK, and then Jabber, JABBER.
Oh, that's great. Well, thank you, Edwin. It's a pleasure getting to know you, and we look forward to having you back on the show, in a little, next year maybe when you're running your own hedge fund.
Absolutely. Thanks so much, Kevin.
Thanks. Take care. Okay, Patrick. Magic Mike time.
Let's do it. Let's talk some charts, buddy.
Thank God. I hope that's all you're doing.
Okay, let's talk about the things that we were watching last week. And interestingly enough, we brought up the Chinese renminbi and just the way that the U.S. dollar has been breaking down against it. And really, it's interesting is that the moment we mentioned it, suddenly the PBOC steps in and says, now that the huddlers know all about it, we got to intervene.
Exactly. They obviously are listeners. That's all we can demise from that.
Oh, no, for sure. But it got a little bit of a bounce. So far, I wouldn't rate it as anything strong. But it definitely, that very short-term oversold state that it was, of that breakdown that was gaining momentum, has had a little reflexive snapback rally. Anyway, number 2 was the G7 meetings. Did you pick up anything out of it?
Not a lot happened. There is talk about trying to make a 15% minimum corporate tax rate across the G7. Going to be difficult to do. I don't know if it's going to get any traction, but otherwise it's been kind of a dud, and that's mine. So I take full responsibility for that dud.
Oh, dud. All right. And number 1 was has the next bull market advance started? And it looked like it was a dud until today. S&P 500 pushed right up toward its previous high. Looks like it's edging to want to break out. The only thing that continues to play out is that the NASDAQ is kind of the dog. Bit of a strong reversal today, though. But even the Russell has been working its way to the upside. But a lot of global developed markets continue to plug along. You know what? I think, we heard Cem talking about it. It's possible that these markets may actually make this breakout here. It's something to watch for sure.
Okay, what are we watching for next week?
All right, well, let's get to it. The next week, we're going to watch those central banks, Bank of Canada, the ECB. There's all sorts of stuff coming out there. Is there anything you're watching for there?
Well, I'm just hoping that we had a little bit of a Frisbee accident with our Prime Minister. I don't know if you're aware, Patrick, because you're down in down south, and it might not have made the news down there. But our Prime Minister is now walking around with a cane because he hurt himself playing Frisbee. And so I'm just hoping that our
it's weird having like a prime minister as young enough to play Frisbee.
Well, I kind of it was a lot better. I sent off a tweet saying it was a lot better than the accident that he had in when he was a kid, and there's a bleeder in Something About Mary. That was it looks very much like Trudeau with the haircut.
Okay,
but anyways,
let's
back
talk
to the joke. Central bank, seriously, Bank of Canada's coming out. I don't see
they were very hawkish the first time around. You think they're going to back off?
No, they're not going to back off, but they set the tone, and it's just going to be all central banks are going a little more hawkish, Patrick. That's the reality of the situation. Cem is correct that the next steps are preparing markets for tapering. We already had Canada tapering. I do not see them backing off and trying to change that. They're going to slowly walk us there, and that's what we should be expecting.
And how about the ECB, though?
Again, same deal. I suspect that, well, maybe not the same deal because they're a little bit behind in terms of their vaccination. Here in Canada, we're flying. We blew by the Americans in terms of the actual percentage of our population that has the vaccine. Our cases are plummeting. I think that if we got a situation where if Europe could have a similar, amount of vaccine available to them, they might catch up and they would be in a similar state. But, unfortunately, they're probably a few months behind us. So maybe this isn't the time that ECB changes tone. But let's face it, the next move is not easier for the ECB. The next move is tighter.
There you go. And so number 2, we were going to talk inflation numbers. Last time around, they came in really hot. And but this time, I think everyone's paying attention to them. It's going to be hard to surprise the market.
Well, who knows? Actually, I learned a great little new thing on my Bloomberg. It's Whisper, WHIS. You can pull it up. I should see what the Whisper number is for the inflation. You interested?
Yeah.
What day is that? Let's have a look here. Inflation number. And do you know what? Now I blew it. I said it, and they don't even do that one. So I look like a fool. But anyways, okay. I don't know what the Whisper number is.
The market was surprised by it the last time. This time, even if it comes in hot, I think everyone's looking for it. I think the market is going to have much more of a muted response to, even if the numbers are outside of the consensus.
You're right. Listen, whenever you get a big surprise, everyone extrapolates and makes another big surprise. Chances are that it's going to be a dud, and the fact that we put it in our top 3 is probably the exact reason why.
But listen, it's something to watch.
Yeah.
It's number 1. We got to talk this breakout in crude oil, and this it's a lot of people take for granted how big the crude oil market is. I remember when we had the visual capitalist guy on our show. Was it Jeff? And he had a great chart on it, just showing the size of crude oil relative to all other basic material markets combined. And oil just dwarfs it. Like it is just such a huge commodity and so important. And the fact that even though we're seeing corrections in so many other commodities, the fact that crude oil is broken to a higher high and is plugging away is just so important. And will this continue or is this a fake out rally? We'll see, right?
Well, I thought you were going to tell me that you don't believe the rally's got a lot of steam behind it.
I do. I don't think so. You know what? I suspect that this rally, even though look, the path of least resistance at this moment and the trend is higher. It's not going to be a shocker for us to see the 70 level or more on the short term. So I'm not short selling crude here, but there's a lot of people that think that this thing is about to go and really start ripping $80-90 in the coming month. And I'm a seller on that idea. I think crude oil here is broken out, and it certainly on the short term can go higher. But I just don't think it's going to pick up the big kind of momentum that everyone's looking for.
I don't know if this will be it, Patrick, but I do know that if you go look at the shape of the curve, the far dated contracts are trading at huge discounts. And to me, in fact, it should be almost the opposite. I do understand there is a short-term demand, but with the reopening of the economy, and I understand that portion of it. But to me, I'm thinking about this in terms of the long-term supply, situation. They're doing everything in their power to make it so we have as little supply as possible. I think the governments are telling you they almost want higher crude oil prices, so I'm not one to fight with them.
So you wrote a piece on that where you and actually Cuppy also wrote about it.
Yeah, don't pretend you read it.
I didn't read it.
Okay, what else you got?
But was it the 2025s? Were you?
Cuppy's buying the 25s. I wrote about the whole curve. I think you can buy I basically own a whole bunch of months. I own some options out there. I also own long dated, kind of the longest duration asset I can see, which is Canadian Oil Sands has the longest duration and has the highest marginal cost. Yes, I know I'm going to hell, and that my university age daughters don't talk to me because I'm ruining the planet with my terrible investments. But otherwise, I like these trades.
There you go. So let's talk about some of the other commodities. I want to look at copper here, and it really looked like last week that copper was trying to turn up. But, one day it never makes a new trend move. You're always looking to see whether the bulls follow through. And really, it looks like some sort of correction is still underway in a lot of these basic materials. I'm not bearish them, but this is the type of a consolidation that inevitably leads to a buy on dip. But will this be one of these 1-2 month consolidations where we could see 4.25 before it becomes a buy on dip for another move? We'll see. But for sure, that short term momentum that put in that top in early May has at this point I think marked some sort of a swing high, and I would not be surprised if we still saw another even 20 cents downside here before the buy on dip.
I got nothing to add. No, I got nothing to add.
Uranium, by the way, this is the uranium participation. Now, this is the one on TSX, but broke out.
Look at that. Giddy up.
Giddy up. Uranium. Are we going to see that 6 to 6.25 on the upside of this? It's a very bullish looking chart, and it continues to work well. And I would not be surprised if. I
think that's even all the more shocking because isn't the Canadian dollar being strong? Yeah. So that thing is priced in Canadian dollars. So that is actually, if you price that in U.S. dollars, which I think I can get you the symbol for the U.S., it's going to be even a better chart. It's like the, here, let me get it for you, Patrick. URPTF, Uncle Robert Peter Thomas Frank. Oh, by the way, one time I did that and I gave all these I came up with my own letters.
Yeah.
And I don't know, all the pilots had a conniption, and they sent me notes saying that I can't do that, and it's like.
Anyway, this chart doesn't look that much more bullish, dude.
I guess you're right. I guess maybe the Canadian. Well, forget it. I'm just 2 for 2 on the duds today.
Yeah, there you go.
Okay, so I'm just gonna be quiet and let you do your stuff.
So gold and silver yesterday got slammed pretty hard. And one of the things that was so important for me to watch was how long does it take for buy on dip traders to jump in, and will it be a 3-day sell off? Will it be $100 an ounce on the downside before they show up? But look at that, it didn't take long. It was less than a 24-hour sell off, and they've got gold trying to go back to 1900 here just as quickly as it went down, and that so far. That's a good sign. We'll see whether or not what I'm going to look for next week is whether or not the bulls will completely wipe out the red breakdown candle. If it does, that's actually a pretty good sign that that gold is going to keep advancing higher. It's definitely worth watching. The other thing I wanted to touch on was lumber. And we were talking about that big parabolic rise in lumber and the way that it finally kind of reached this blow-off top, but these failed rallies and that all-important 1,500 number you were making fun of me on seemed to have kind of kept all the buying underneath. And what's interesting about it as well is that with this top in place, I have here the term structure going out to the summer of 2022 on the lumber contracts, and you can really see that the backwardation is very evident. And once you get out even to November, we're under $1,000. And just it goes downward. So clearly there was some sort of a supply-demand shock that created this jump. But the markets, in my mind, are really pricing in a normalization of lumber prices. And, what's interesting about it as well, Kev, if you go and look at the lumber chart, and this is a continuous, but go back and just look at a weekly chart going back a decade or something like that. I mean, there was a prolonged period where lumber was just a range-bound dead market. So you could go back 30 years, right? And this breakout, just look at the craziness of it. I mean, even going back to the 1,000 level on the downside, we could easily. It's still considerably higher than the 30-year range.
I guess I never really realized it. Yeah.
Right. When we kind of oh, that's so bearish thing going down to 1,000, that it's still, that would be barely a 50% retrace of this entire absurd rally, right? And so a point is that overall, I think I don't think lumber prices are going anywhere back to that trade range, and I don't think we're going to see anything back to 500. But this went too far, too fast, and us mean reverting here back to the 1,000 level or so in the next couple months, I think is something that will naturally happen. Anyway, do you have anything to add to that?
No, nothing to add.
All right, then let's stop with the charts. That's enough for today. All right, let's go on.
So we're going to go to skin in the game. And I got tagged, and I have a confession to make. I made a rookie mistake.
You gave me the choice.
No, it's not that. I made a rookie mistake.
What did you do?
You picked correctly, and not just for the reasons that you think.
Okay.
Why do you okay? So when we bet on the VIX index. So for those who know, I bet. So it was Friday afternoon we did this, and I said that the average of all closes next week, this week that we
on a
just
shortened
had,
week, we knew it was going to be shortened.
yeah, will be. That's even worse. Will be over or under, which was the closing price on Friday.
Yeah, 16.76.
Now the problem is that I continually always trade VIX futures or the VXX, like the actual tradable instrument. And I don't trade the VIX. I don't even pull up the VIX, as we kind of embarrassingly found out. I don't even have live quotes on the VIX, right? And so I don't watch it as much, and I didn't think it through. But the problem about the VIX is that on Friday, before the long weekend, the market makers pushed the price of options down because
for a 3-day weekend.
The 3-day weekend and things like that. So in essence, I ended up setting the price at a lower level than it really should be, because when the VIX calculation, it bases it on Friday afternoon and a regular market, it doesn't take into account that the market makers are pushing it down. So this was just a complete and utter rookie mistake, like just embarrassing rookie mistake. It's like
And
it's like rating a beer 6.0 like you do. It's terrible. I deserve every. What did I lose?
You just added a pitcher to.
I added a pitcher. I'm actually going to give I'm going to penalize myself
2
an
pitchers.
extra pitcher for stupidity.
Shame on you.
Okay, Lena, mark it down. I'm penalizing, like I'm gonna be like self-flagellant or whatever they call it. Those guys that whip themselves or whatever. I'm giving myself an extra pitcher to pay because that was the dumbest bet I've ever made. I deserve to be schmucked. Honestly, I'm embarrassed.
There you go. All right. So why don't you quickly go through the rules and let's make a new bet.
Okay, so. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer, a burger bet, a pitcher, a case of beer, which is a 2-4, a bottle of wine with a $100 limit, and the steak dinner. The winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions. I see you were dipping in. Did you dip into the little bit of the fun there?
No, this one was out of the big picture trading pocket. This one.
Oh, okay.
But you are contributing to the Miami Huddle Muddle. A few of the drink costs, but the majority we're still saving for the Toronto piss up.
The real one. Okay.
The real deal. That's where shit's really gonna happen.
That's where it gets
all
real.
right. So let's.
What
do
do you
this,
got
buddy.
for me?
All right.
Hopefully you'll do a better job than my.
You
can't do any
I like
worse.
to keep. I'm just going to keep it simple on what it was the most interesting thing and that we're watching. I want to go to crude oil and give you an over under on 70 for Friday's close.
Which contract though? Because it might roll.
No, the July.
Is the July still going to be? Well, let's just make sure because that might not be.
Yeah.
Let me just look. Last trade date is. Oh no, it's okay. We got.
Yeah, we should be okay.
Yeah, we're okay. Over under 70.
Yeah.
Oh, you bastard. Over.
There you go.
Yeah.
All right. I don't want to bet too big on that, but I can. I'll do a pitcher for that.
Okay, you're on.
All right, we're just going to keep piling on.
Just keep piling the pictures on until we get this huddle muddle.
Like, Lena's going to have to report to us how many we have to settle. Are we over 20? Or we must be somewhere in the teens.
Oh, I don't know. Lena, hop on.
Yeah, I'm looking at it right now. We've got about 13.
Oh, I thought
That's
not
not that bad.
That's not bad.
That's just the pictures, yeah. So it's not
Yeah.
about 13. I could be wrong. Maybe I don't know how to count properly, but yeah, definitely 13.
All right. Anyway, so there'll be one extra one after this week. All right. So let's go. Actually, that's it for. Let's do the close.
Okay. So where am I here? Oh, yeah. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle. Lena's on there every day. She gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get all of our latest content. And I was just looking through trying to find some reviews on iTunes to read out here.
And there were none. No.
There was some nice ones. There was some people that didn't seem to like some things.
Really? Well, why don't you let us know?
Oh, only subscribe if you want to waste your valuable time. Not worth it.
What?
Josh did not like it. Josh, reach out, buddy. Fine. Tell me what's wrong. Tell me what's going on. Anyways, Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and find me at bigpicturetrading.com. And Kev, where can they find you?
I'm on Twitter at Kevin Muir, M-U-I-R, or you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends, including you, Josh. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Really?
Okay.
Somebody left a comment like that on our...
Oh, I don't know.
review like that?
I'm just trying to figure it out. I was like just quickly doing it. For those who don't realize, we're running a little. We're trying to get a lot of things done a little quicker than usual because Lena is on the way to the U.S. of A.
That's right.
And so we're rushing a few things.
Yeah, she's coming down. I already had the little New York little huddle model. Great meeting so many of our listeners. They all have nothing but great praises for both of you. They all love you, Kev. They love Lena's laugh, so we have to make her laugh more. But they had nothing. They had nothing good to say about me, though. It was like, well, you know, I'm gonna pass on the compliments, but geez, like.
Now you're just fishing.
Tough crowd. Tough crowd.
How's the beer? You got to rate it. You're the only one drinking that.
Yeah, you know what? So. It's definitely like its own category. Like you have to be in the mood for a Corona style drink. But if I had this versus a Corona, I would take this any day. It's actually a nice, smooth summer kind of beer. I'll give it a 7.8.
Oh, that's a high one.
Wow.
Coming in hot.
Sounds like it would be good with like tacos or something.
Yeah. Like
speaking of tacos, did you go to Mexico like I told you to? No.
Oh, no. I've hit a couple of really good restaurants though, but I've been doing the little speakeasy tour and with all those little
there we go again.
bars.
This guy's stuck in 1922. Went to the speakeasies and the flappers were there. God.
Oh yeah, we're drinking our drinks out of like little mugs and shit like this. It was dark alleys. It was awesome. Sneak into the back of barber shops and shit like this.
Really?
Yeah. It's pretty fucking awesome.
So here we go, Patrick. So I fall in love with these 9 iconic cocktails from the 1920s. These are for you, buddy.
Right.
The Gin Ricky, the Bee's Knees. Who knew that was an actual drink?
I didn't.
And listen, it's the bar. It's oh wait, no, this is from Brooklyn. Of course, it's from Brooklyn. The South Side, the Singapore Sling. Again, I knew that one. The Hanky Panky. Oh, no Hanky Panky. The Sidecar, the Bamboo, the Mary Pickford. I don't know why, but I like that one. It just sounds cool. I want a Mary Pickford.
What's in these drinks?
Well, let's just do the Mary Pickford only. Named for a film actress widely considered the premier, I don't know how to say this word, so enchilada of the 1910s and 20s.
Is that a your thing whenever we don't know how to pronounce something?
The Mary Pickford mixes white rum with maraschino liqueur, pineapple juice, and grenadine, resulting in a sweet, fruit-forward, chilled libation.
Very nice.
If it was up to me, I'd see the Mary Pickford cocktail make a comeback with white rum and tropical juices. It's the perfect summer cocktail in a 1920s classic that is included in the International Bartenders Association cocktail book. Okay, so Patrick, it's on you, buddy. You're going to make the Mary Pickford make a comeback. Just go around, say, I hear everyone's asking about this Mary Pickford.
Done. Send me that link on WhatsApp. I'm gonna make sure I get
See,
the bartender.
do you know what you should do? You should just test the bartenders because it's in the book. See if they have to go look at the book to do it. Now, the reality, though, is that they could probably fake it and you wouldn't know the difference. They could just put random shit in there and you'd be like, oh, yeah, that's a good Mary Pickford. Not having a clue what it is. Okay, now on to more important things. Did you guys realize it is National Donut Day?
Oh, no.
Ooh.
Today?
Yeah. National Donut Day.
Had I known earlier, I would have gone to Krispy Kreme.
Oh, I feel like you got to go to Tim's. Although Krispy Kreme's a better donut, but I feel like you got to just...
I'm going to do a Dunkin' Donuts down here.
Oh.
Yeah.
I haven't had
National
Dunkin' Donuts in a
Donut
long
Day.
time,
Yeah.
What's your favorite donut? What's the one you eat?
I don't. Oh, I like. Well, I don't know if it's a donut. I love the Bear Claw.
I don't
The
think it's a
Bear
donut.
Well, I'm
They
looking
said
at the donut glossary on Twitter,
Come
and
on.
they got the Bear Claw in there.
I've like
Bear
been to.
Claw's considered a donut?
I don't know. And an apple fritter. I don't know if they're considered. That's what I like.
Mine's a
I'm
honey
sorry.
cruller.
Really?
Honey cruller.
Yeah.
Yeah, I get it.
I'm a basic chocolate dip guy. Like I
you?
go with the plain vanilla.
Or original
Chocolate
glaze
dip.
from Krispy Kreme will do. I used to get like half a dozen of those and eat as lunch in high school.
Really? You know what's funny? When I think it was Johnny Depp was trying to put on weight for one of his roles.
Oh my god, trying to put on weight.
Yeah, I know. That's like exactly. It'd be bad, right? Like that he's got this problem. Okay. But anyways, the point is he was having trouble, and he was having real trouble, and so he tried a million different things, and the thing that got it was the donuts.
The donuts. Oh.
I mean, it's fried dough with lots of sugar.
I know,
You know,
right?
like-
Yeah. So,
Surprise. Well, why didn't he try McDonald's?
Well-
Supersize me.
okay, so here we go. I found this thing I wanted to do. By Canadian region, their favorite donut at Tim Hortons.
Okay.
Okay, so this is it. So here we go, okay? Let's start with our good friends on the Western Canada. So we're doing BC, Alberta, Saskatchewan, Manitoba, the whole West. Okay, this might explain my donut choice.
Oh.
The most requested donut at Tim Hortons in the Western Canada was the apple fritter, followed by the Boston cream and the honey cruller. Okay?
Huh.
Okay.
Now, let's go look and see here. Ontario and Quebec. Oh, again, the apple fritter comes out the most
Really?
popular. Boston cream, same deal. And then old-fashioned plain.
Ew.
Yeah. Then Atlantic
From Timmy's,
Canada.
though, right? Like,
Yeah.
no.
Okay, so Atlantic Canada, they finally spice it up and do something different. What do you think they got as their number one donut? And it actually makes sense if you think it through.
Oh.
So, some like lobster.
Yeah, it's a lobster donut. You got it. Although you're kind of on the right idea. Which donut is from the east, northeast in the U.S.?
All right. Okay. All right. What is it?
Oh God, everyone
gonna-
that's
Beaver
listening.
tail or something?
It's the
But they don't
Boston
have that.
cream.
Oh.
Yeah. Anyways. So guys, get out there and by the time this goes out, it's going to be Saturday, so you can't go out, enjoy National Donut Day. I hope you have. Hope you
We
helped
gotta
out the
figure out
donut
what
makers
day
of
is
the
it
world.
for tomorrow. What's the national whatever day tomorrow?
There's like a national something every day, isn't it? Like this is the
Yeah.
the
Yeah.
bee day, the enchilada day.
Enchilada day.
There's
What
been
if
a
you're-
lot of talk about how you cook these things.
Official enchilada.
Okay, so how do I say it again? Cicadas?
Cicadas, I think.
I think, okay.
that's how you say it. I don't
Okay,
know
so
if
the
it's cicadas or
cicadas, I got it.
cicadas.
I did hear that you want to eat them within the first two to 3 days, because as they only go like 4 days or whatever.
Oh, you
And
mean cicadas, not enchiladas.
yeah, cicadas, and then they get harder as they go along. Oh, that sounds bad. They get harder as they go along, and like they only live like 6 days or whatever.
So wait, why do I want to eat them?
Because Lena, don't you know that bugs are the protein source of the future?
Oh my God.
They honestly, people are always trying to get that. Like they're always talking about eating bugs. It's like environmentally friendly and stuff.
I see.
Well, thanks for
now I
sharing,
know.
Kev.
Yeah. Oh, one last thing, I'll just leave you on a little bit of a down note. I was listening to Peter Zion, who's a good guy, and I like him. He's a macro. No, he's kind of. How would you describe him? He's a geopolitical analyst, I guess, which I don't usually like. I'm usually like geopolitics. That's terrible stuff. It just gets you in trouble in terms of the P&L. But anyways, he had a great little piece out this morning, and he was talking about the different COVID viruses. And did you know that there's now a strain that's going into mice and rats?
Oh,
Thanks for
shoot.
sharing, Kev.
I know. Like this,
Patrick's
like,
in New York.
I'm
You know
like,
what that means.
Yeah. Mice and rats. So which means he basically says we'll never get rid of this thing, which obviously we probably never were going to get rid of it. But it's like we don't need
COVID's
these
here to
things in the
stay.
mice
It's all
and
about our
rats.
ability to
Yeah,
create
so
some sort of a
don't
herd
touch
immunity
rats
to
or
it.
mice.
Oh, now you know what I just remembered? Okay, you guys talk amongst yourselves for just 2 minutes. Keep this conversation going for 2 minutes without me, and I'll be back. I got something I want to talk about.
Oh.
You got pressure. 2 minutes.
2 minutes. All right. Well, no, but so Lena, you're taking off. We're gonna meet up in Miami, which is
Yeah.
awesome. We're gonna
Yeah.
do the piss up.
And we're gonna go to
With-
Shake Shack.
You're gonna hit it up in Atlanta though, right?
I don't know if I'm gonna have time. It's gonna be a bit of a stopover, but I don't know if I'll have time there. So if anything, I will have to go to Shake Shack and Trader Joe's when I'm in the U.S. of A.
Why Trader Joe's?
Oh, they have the best snacks there.
It's just a grocery store.
No, they have good stuff there that I can't get here. So that's gonna be my mission. But I would be interested to know if there's any interesting places to stop from Toronto to Atlanta or to
No.
Miami rather.
No.
And then maybe
there's places to stop, but like when you're taking the interstates, you're really off the beaten path of like where all the cool shit is, right?
I know.
So
It's gonna be
everything
kind of a
you're
boring
deviating.
drive.
Yeah, you just have to just put the pedal to the metal and just get your ass down there as fast as possible, and then start partying.
I was at Shoppers Drug Mart today, getting my test done just in case, and I was messaging Luke while I was waiting for my results, and I said, I'm contemplating if I should get adult diapers because of my small bladder. I don't know how this is gonna work with this long ass road trip.
Oh yeah, you don't say shit like that on the podcast. That's like one of those personal things, right?
I just need to know if there's a pit stop somewhere between.
Oh,
here and there.
that rest assured, there's like every.
But I don't know what's better, like to go to a pit stop in the middle of nowhere, or
No, it is actually better to stop at the pit stop.
yeah.
Yes, yes, it is. There's some really great.
Hopefully, I won't need to use adult diapers.
Is Kev back?
I'm still looking. I can't find it. I was listening to this podcast, and they were talking about this book of recipes. And it's a famous old book. And if anyone actually knows
Joy
this,
of
please
Cooking?
pass it along.
Is that what you're asking?
And it was all sorts of different things because these guys were talking about the fact that these cicadas were not in this book. And this book basically is how you cook every strange animal known to man. Okay? And the reason I was bringing it up is that there was a squirrel stew in there.
Oh.
And this guy was trying to say that the squirrel was actually not as bad. You just need to do it in a stew. And it's not that bad. And I was thinking of Patrick, and I was like, I got to find this book because I feel like Patrick should have just cooked it wrong. And that he should have
Who
cooked.
has time for a stew?
Yeah, but I like.
You said it was like gamey or what? Like what was the
It's just small little things.
Yeah, like how much like
You know what I did have here? I went to this fun little restaurant called Excuse My French, and I had a bucket of like frog legs.
frog
Really?
wings?
Wings. They look like wings. I'm like
Frogs with wings.
frog legs. Man,
They taste like
that's
chicken.
something different.
They
Yeah,
taste like
you know what?
chicken,
It's like but it has like a texture of fish, but it tastes like chicken. Yeah, it's but it was that was first for me. I had squirrel before frog legs.
really well. You're Canadian, of course. You had squirrel before frog legs. Okay, well, on that note, we'll just let it go. I'll try to find the book. If anyone knows the book, please. It's something like it's from the 50s or 60s, or maybe even the 70s. But it's a very famous book of all sorts of recipes for every animal that you might run over with your car.
It's not Joy of Cooking. It's not.
No, it's not Joy of Cooking. Like wouldn't that be funny if Joy of Cooking had like squirrel section? Joy of Cooking. Let's just see if I go Joy of Cooking squirrel. Anyways, yeah.
So the next time we're on together, Lena and I will be drinking with Cuppy.
That's right.
And you are going to be the lone man stuck up in Toronto.
Yeah.
My
Well,
condolences, Kev.
you guys enjoy yourselves. Have a safe drive, Lena.
Thank you.
And I hope we didn't keep you up too late tonight with all the editing. It's mostly
No,
Patrick.
Not at all.
Yeah, it's mostly me.
It's okay. He doesn't listen to it anyways.
I hope you leave the flub in the. I hope you leave the flub at the beginning in there.
Oh, I will.
Flub,
Oh, nice.
I just didn't speak. What was that? My cue? All right. Have a great weekend, guys.
Have a safe flight. Or
Yes,
safe drive,
yes.
Lena. And everyone
Thank
have a
you.
great week. See you next
Cheers.
week.
Bye-bye.